everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The first time this year, the market is starting to get nervous about the potential or higher probability of some sort of harder landing.
All equity markets are at a risk simply because you are at the point where the unemployment rate in the U.S. is very low, is starting to pick up.
It's clear to me that we're going to see slower growth over 2024 relative to 2023.
It was only a couple months ago where the narrative was re-acceleration even, but I think the data now have more clearly slowed.
The market is expecting this slower growth and inflation outlook. That doesn't mean that you're going to have a hard landing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Is this the beginning of the end of big tech dominance? Right now, welcome back. This is Bloomberg Surveillance for our audience worldwide. Good morning. Danny Berger, Anne-Marie Hordern, Lisa Abramowitz. Jonathan Farrow is off until, I believe, Thursday. I begin saying it's a little overdramatic. Is it the beginning of the end of the sort of big tech dominance? But that's really the ultimate question that we ended last week with. Suddenly, for the first time in a long time, small caps were outperforming and big tech showing some real nervousness that maybe they can't keep climbing to the sky.
That's going to be the important thing for the bulls. If tech dominance stops, can the rest of the market catch up? If you look at what the market's done so far, the things that have done the best quarter to date, it's utilities, it's staples, not exactly ringing endorsements for this economy.
Which really speaks to this question of, are we seeing a softening that's welcome or a softening that's not welcome? Later this week, we do get core PCE deflator, that key inflation metric the Fed looks at. We also get personal income and personal spending. This is really the key question. How much can the American hedonism engine of consumerism really continue to propel this economy?
Well, this is the big question alongside jobless claims, which we have been ticking up. And what everyone's trying to look for is the disinflationary story, some of the cracks seeing in the labor market. Is it going to be a trend enough to put a rate cut earlier than what potentially December, which some people are looking at September, and then there's some big wagers in the market for potentially July.
You know, I have to say there was one report over the weekend that really caught my attention, and you were talking earlier, Anne-Marie, about bifurcation of the consumer, of how the high-end consumer is the one that's really been propelling all the spending, and the reason why we have this article that is a little obvious about what you can do to avoid the crowds in Europe if you're an American traveling there. There was this report from Torsten Slok of Apollo. The median expectation for inflation was substantially higher than the average. Basically, what he looked at, Danny, was this idea that the lower-end consumer is actually expecting inflation to climb dramatically over the next 5 years in a way that maybe the higher-end consumer isn't. This sort of speaks to maybe on the margins, inflation expectations are becoming unmoored in certain segments of the population. How long could this sort of divergence continue?
And can the Fed cut if there's this concern about inflation expectations getting entrenched? If you have this whole swath of the population who thinks inflation is going to be 5% or more in 5 to 10 years out. The one thing, though, is can there still be disinflation even if that's the case? If you have middle income and lower income consumers who have pulled back on spending, even if the upper end is still traveling, going to Europe, still spending, you probably can still get disinflation. So it's how much do those entrenched expectations bleed into their habits?
And how much does a rate cut reignite a housing market with people still looking to get in, but people not looking to get out of their houses as quickly enough to offset some of the pent-up demand. Right now, the way that it's shaking out in markets is, at least the divergence on the margin is continuing, with stocks basically, futures unchanged, 55.34, completely flat. You can see the Russell 2000 still outperforming, albeit, it is just a fraction of the size of the Magnificent Seven. I will just note that in terms of size. Euro gaining versus the dollar, just about up about 0.4%, 107.33, strengthening. 10-year yields higher just about a basis point, 426.90, and crude up about 0.4%, $81.08 traded on the NYMEX. Coming up this hour, Vinu Krishna of Barclays on why a broad market rally, as we were just talking about, is still possible. RBC's Tom Narayan on why Tesla's robotaxi bet might not pay off, at least not as much as people think. And Stephanie Roth of Wolfe Research looking ahead to key data, including the PCE deflator. We begin with our big story. Stocks looking to make a comeback ahead of a busy week of data and key earnings. Vinu Krishna of Barclays writing this. A question we've heard recently is, what will it take for the rally to finally broaden? We continue to think earnings growth is the key. All in, big tech and the rest of the S&P 500 are expected to deliver similar earnings per share growth beginning around year-end. Provided the macro backdrop remains supportive, we think this could go a long way toward justifying a broader rally. Vinu joins us now completely on cue, because this is really the key question right now at a time where it seems like on the margins you're beginning to see a broadening out, a Russell 2000 that's outperforming as people kind of pair some of their bets on big tech. Why do you say earnings will really determine the trajectory of this going forward?
Good question, and thank you for having me. So I think the first question is, if you look at what the channels obviously for returns are, it's valuation and it's earnings. On the valuation front, our view is that we are fairly fully valued. Whether you break it up into big tech or rest of S&P, we think, in fact, that that being a channel for returns is limited. But what we did see in the first quarter earnings was big tech earnings accelerated even further, not just realized, but forward estimates. But finally, for the rest of S&P outside of tech, we saw divisions moving in the right direction. So big tech moved from forward guidance of around 10% to 20%, so it's phenomenal. And the rest of the market moved from around 2% to 5%. So finally, we're beginning to move in the right direction, even though the delta between the two is massive.
I guess when you're talking, I'm thinking why? Why is some of the profit expectations increasing at some of these smaller or more leveraged companies? Rates aren't going down. The consumer, people say, is weakening. We got some weaker than expected economic data pretty consistently over the past couple of weeks. Why are earnings actually managing to increase, at least expectations, for some of these smaller, more highly leveraged to the economy companies?
Sure. Just to clarify, it's not about small caps. It's the rest of S&P, right? Because S&P itself is so concentrated and so bifurcated, so we don't even have to go till small caps. In fact, our view has been, we've been negative on small caps for over a year, and we have not changed our view. Even though this whole broadening trade has been the most popular trade on Wall Street for 9 months, and we've been on the opposite side. We still remain on the opposite side. So we still think it's large caps or small caps. So to answer your question, I think it is all about what you figured out from first quarter earnings, right? And there, for the first time, not only did we see margin continue to improve for the third quarter in a row, but for the rest of S&P also incrementally nudged in the right direction. And so, our view always was the last 3 quarters, the final improvement in margins was all concentrated in tech. So even now, it is dominantly concentrated in tech. But there are some glimmers of hope. But that said, our view is that we want to wait and watch for the broadening to take place. That's why we remain kind of skeptical on the borderline. And that is because it is just 1 quarter, right? And we are beginning to see cracks in the consumer. And which means that companies which took advantage of COVID as a one-time opportunity to raise prices without fear of a competitive reaction, now are finally facing a situation where final demand can be moderating a little bit and consumers are becoming more careful about where they spend the dollar, marginal dollar at least. So we think that does translate into some sort of margin pressure. And surprisingly, I think where the equity and markets need to pay attention is that compared to historical, the way the market reacts, some of the more defensive areas in the market are the place where there is still some margin pressure, especially staples, right? And so if things were to go wrong, the kind of protection expected from staples may not materialize. So this is a fairly complex market. Like say, highly concentrated and yet very high dispersion. It means it's a stock picker's delight, but they are struggling to outperform the market. Less than, I think, 20% of funds are actually outperforming the market. So this is a tremendous challenge.
I was going to say, Vinu, I mean, why would I buy anything other than a passive S&P 500 fund right now? Because it will capture all that upside of the larger companies who keep getting larger, and presumably, if you're an active manager and you're outperforming, you're even more overweight those companies. So how does an active manager even try to get fund flow in a time like this?
That's an excellent question. So to give you a sense, we've been positive on big tech since the fourth quarter of 22. And we haven't changed our opinion since then. And to your point, when we get asked this question about asset allocation, in fact, it's the question we had just recently. And this is what I told them. And even I'm not an asset allocator, right? But I'm just being intuitive in terms of, right? You can have the market exposure to big tech, right? And by the way, correlation between those stocks is 40 to 50%. In other words, you can nuance your opinion within those 6. The correlation of big tech to the rest of the market is only 20%. It means dispersion is very high. You can go and look outside, right? So I think it's the way you construct your portfolio. And then on the front end, on the cash market, you're still earning 5.35%. So I would say put 20% of your cash in front end, keep rolling it, because even if rate cuts come, you're still going to be in the 4s by the end of next year, right? Maintain your market exposure to big tech and play around on the margin a little bit, and then you're left with roughly 40%. Knock yourself out by trying to be an active picker and then go and find the value because dispersion is allowing you to do that.
First of all, I love that you still see cash having a place in a portfolio.
Absolutely.
Because there's lots of people who have come on, I know this program, and have said it's time to look away from that.
Mainly credit folks.
Mainly credit,
yes.
Yeah, so maybe a tiny bit of book talking. But okay, with all of this, you mentioned things like staples are no longer your safety. So where do I get safety? If I am not just buying the S&P 500, I want to turn to an active asset manager. Where should I be finding a safety trade that can be my ballast in an equity portfolio?
So let me give you one approach of doing that. So that's exactly what we tried to answer recently, saying that you can't get stuck in 6 stocks, right? It is getting scary because concentration by any metric you look at is in the extremes. So one approach we looked at was, why is big tech doing very well? So on a host of fundamental metrics, they're killing it. So we said, how can we try and look outside in the 494 stocks and try to approximate those levels of financial metrics? So you cannot replicate it, but you can try and come close to it. And if we take a diversified approach, we actually managed to pick about 50 stocks in the rest of the 494 stocks. And our hope is we're going to rebalance it every month and see how that's doing. So I think this is not a sector-oriented market, because traditionally in asset allocation, or 80% of returns come from the sector, but we think that's not the kind of amount. You want to wear a growth hat, a quality hat, and then scour the market, keep it diversified because you're trying to avoid concentration, but keep your exposure to those big 6, keep your exposure to to cash, and then play around in the middle with that 40-odd%.
Your notes reflect some conviction you have. I want to ask you about the presidential election. Lori Calvasina was talking about this paralysis investors may feel. But you have conviction on potentially what we may see after November. How do you prepare equities for that?
Well, you cannot prepare for it, right? Because the point is that it's a close election. It can go any way. But you can just look at history to get some sense of how the market has behaved. So interestingly, historically, if you look at how markets behave, returns during election years actually behave less than the prior years, in normal years. Second is when Democrats win, typically we have found that in the first year, returns are better. But on the other hand, when Republicans win over a 4-year period, returns are better, right? So I think the biggest thing right now is focus on what policies they're touting and try and see what the impact on the market is. That's what we tried to do recently. So if you have a Trump regime, for example, and if they follow up on some of the tariff discussions where 60% on China, 10% across the board, rest of the world, and we assume that what if the world also retaliates? They will, right? So they're not going to be sitting and taking tariffs from our end. So that impact on earnings, we think, is going to be almost 4% in aggregate. On the other hand, if you have taxes, and if Democrats come and there's a blue wave, which we think is highly unlikely, and taxes somehow go to 15%, there's a tailwind of almost 3.5% to earnings. But you flip it and you say Democrats come and they raise taxes, to 28%, then your hit to earnings can be almost 7.5%, based on taxes going up and the taxes on buybacks. So I think it's a mixed bag. If you have a red wave versus a blue wave, but our view ultimately is that it's going to be a divided government, and that will act as a balance from some of the more extreme measures, and the market will do fine. Politics, we talk a lot about it till we enter it, and then we move on with our lives.
Unless you're France. Vinu Krishna of Barclays, thank you so much for being with us. Vinu Krishna there joining us. Let's get to an update now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakas. Yahira.
Hi, Lisa. NVIDIA shares are falling in the pre-market as the stock is set for a third session of losses, putting it on track to wipe out nearly $300 billion in market cap. The stock has surged this year, propelling the company to briefly become the world's most valuable, a title it's since lost after the latest drop. NVIDIA's market cap is now below both Microsoft and Apple. Also falling, Bitcoin. It's extending its drop after crypto suffered one of its worst weeks this year. A gauge of the largest 100 digital assets fell about 5% in the 7 days through Sunday, the worst such decline since April, according to data compiled by Bloomberg. In earlier trading, Bitcoin fell as much as 4% to trade at a more than 1 month low. And Tomorrow Sports, the company co-founded by pro golfers Tiger Woods and Rory McIlroy, has secured backing from Dynasty Equity Partners. The funding round values the company at about $500 million, according to people familiar. Tomorrow's first project is a partnership with the PGA Tour for an indoor golf league known as TGL, which is scheduled to launch in January and air on ESPN in the U.S. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls. RBC's Tom Narayan cutting his Tesla price target on lowered robotaxi estimates, talking about maybe the profitability just won't be there as much as people previously thought. That's coming up next. This is Bloomberg Surveillance.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are still talking about traveling to Europe and summer plans because that seems to be where people's minds are. Welcome back. This is Bloomberg Surveillance. We have been looking at a market trying to find its footing after really seeing that rotation under the surface. We did hear a bit of caution this morning from RBC Capital's Lori Cavacina as well as Principal Seema Shah. Question around what we just heard from Vinu Krishna talking about, yes, maybe there are some things to like with under the surface, but their benchmark base cases for declines going into year end. Time now for the morning calls. First up, TD Cowen upgrading Planet Fitness to buy with a price target of $92. The analyst saying the company has, quote, compelling catalyst path, naming it a top small mid-cap idea. Next up, Baird raising its price target on Micron to $172. The analyst noting the chip makers' rising exposure to the latest so-called high bandwidth memory technology, seeing high gross margin and pricing potential. And finally, RBC cutting its Tesla price target to $227, but maintaining an outperform rating. Analyst Tom Narayan lowering estimates for the company's robo-taxi venture, expecting more competition than previously thought. However, Narayan still seeing the robo-taxi as the biggest driver of valuation. Tesla is expected to unveil its long-promised autonomous vehicle on August 8th, which is really a key feature to the robo-taxi discussion. Tom joins us now. Tom, wonderful to get your take on this. I want to start with why the robo-taxi is so essential to Tesla's future at a time when electric vehicles are still being sold and they've managed to actually do all right in China.
Yeah, I mean, you can't get to their $700 billion valuation on just a car business. It's just mathematically impossible. The way you get there is through autonomy, which is FSD to some extent, but it really is the robo-taxi business. It's a very high revenue business. The utilization for miles traveled goes up way more than a regular private car, and it increases the total addressable market in the transportation industry, taking share from planes, from trains, giving people with disability, children access to mobility. So from just a TAM basis, it increases the overall pie for transportation, and that's really why Tesla's going after this so aggressively.
And it is the idea of a robo-taxi, one without a driver that can go around. San Francisco, I believe, had some of these by GM in testing form, but then had to pull it back. Your big issue, at least with the valuation, is that you don't think that this is going to be as profitable as many people, including yourself, previously thought. Why? Is it competition? Is it just demand and kind of where consumers are willing to spend?
Yeah, it's interesting. When I did this price target cut, I got a lot of pushback from Tesla bulls thinking that I don't like robo-taxis or something. It couldn't be farther from the truth. I still give them $400 billion plus of value from robo-taxis. It's over half of my entire valuation. It's just that compared to what I had thought before, I've lowered my pricing assumptions with the help of our internet team who covers the ride-sharing companies Uber and Lyft. And I've also reduced the amount of revenues they get outside of their own walled garden for things like software. And I do believe ultimately the app, right, Uber and Lyft, those guys will have a lot of power, a lot of say in the future of robotaxis. There will be other players in the market, others making cars, software, other apps. But I am still very bullish on robotaxis for Tesla. I have them getting over 20% market share in the US. That's 70% of my robotaxi valuation is their own walled garden, their app, their car, their software. It's just that I've lowered the non-Tesla portion of my valuation because I do think there'll be other players. This will be a very regulated market. Government's not going to just allow one player to, dominate everything. That's why I think pricing comes down. And I do think other players will play a bigger role as a result.
Well, Elon Musk has thrown some pretty big numbers out there, Tom, when it comes to what valuations he thinks Tesla will be when it comes to the robo-taxi. I want to ask you about a different number. He said this was at their shareholder meeting earlier this month. He said that Optimus, which is their robot venture, could lift Tesla's market cap to $25 trillion someday. What do you think about that?
Well, I mean, certainly a lot of things could happen, right? And so I'm not discounting that at all. It's just that, my valuation looks at businesses that they already have, energy storage, obviously the car business. I give them credit for robotaxis because of the leadership they have in FSD, full self-driving, which I do think is a precursor for what they'll eventually do in robotaxis. So currently, I don't have the robot in my valuation. We'd have to see more evidence of it to see what that really looks like. But yeah, I mean, this is a name that has a lot of upside potential. So I'm just looking at what we know today, and that's what I'm using to get my valuation.
When you talk about competition coming to this market, do you mean EVs coming from China, Tom?
On robotaxi specifically, I just mean other players making robotaxis, right? So, just look at the ecosystem of regular taxis today, or even when you use your Uber app, different OEMs are sending a car to you and you're getting inside that car. I do think they're going to be the biggest player in the US, but look at China and then look at Europe. I don't think Tesla will dominate China. China's going to want to have their own national champions and potentially so in Europe as well. So it's more to do with the fact that I think the overall robotaxi ecosystem will be fragmented. There'll be a lot of players. I do think Tesla will be a really strong player, especially in the US. But it's just to note that in the robotaxi ecosystem, especially since the government will regulate these markets, I don't think they'll allow for, one ring to rule them all, a monopoly or so to speak. I think there'll be a lot of different players, and that's something that I wasn't really accounting for in my prior evaluation.
Just real quick here, Tom, which other auto manufacturer do you think is going to present a real competitive edge versus Tesla in this field?
I don't know if it'll be like another, like a duopoly type thing. I think it'll be fragmented, right? It'll be OEMs with theirs using, let's say, Mobileye software or somebody else's software, or it'll be, the app will have a strong play, and that could be Uber and Lyft, but with different OEMs. And certainly today we know Waymo, GM Cruise are strong players in this. I don't see why they couldn't participate in it as well, but it's too early to tell, I think, outside of Tesla, who will be strong players. I do see it being a fragmented market with different types of players doing different things. Tesla will have, I think, a walled garden approach with the total ecosystem, but that'll be some portion of it. So it's not really like there'll be another company that will, rival necessarily Tesla. It's just there'll be a series of different players coming at it from different angles.
Tom, thank you so much for being with us. RBC's Tom Narayan there on his call. It still is bullish on Tesla. Let's be clear. His price target isn't exactly calling for it to go down, just not up as much as previously. We also, I got to say, I'm actually really looking forward to robotaxis. I don't know, people who are saying not so
2040,
much.
that's when the global adoption people think it's going to happen.
Get me one with a gym inside. Love it. Go on a run.
You have
perfect.
You have a whole other vision right now of what exactly a robotaxi is. Where does a gym come from?
Oh, just put a treadmill in there. It could work.
All right. Coming up next, Morgan Stanley's Vishy Chirvatur and Stephanie Roth of Wolf Research. You're watching Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
About an hour until the open of the trading week to the last week of the month, as the last week of the half of the year of 2024, which has seen a whole host of different narratives. Current narrative, unclear. Is weakening weakness? Do we see a rotation under the surface? Right now, the answer is yes. S&P futures up about 0.1%. NASDAQ down about 0.1%. Danny, the Russell 2000 up 0.3%. I'm thinking about what Vinu Krishna said. It's not just the Russell 2000. But in general, maybe some of the profit estimates for big tech have gotten over their skis, and the profit estimates for the rest of the 493 just aren't high enough.
Yeah, I mean, even with the bigger profit estimates for tech, I mean, there's been some pretty incredible multiple expansion. PE ratios have gone up something like 20 percentage points this year. I think it's more like 50 if you take it from October. That's not really earnings based, that is momentum, that is just plain and simple multiple expansion. So when you talk about the market turning, it could be that. Maybe we just jumped the shark a bit.
Well, right now, a lot depends on what happens in the rate space. And what we see in the rate space is just marginally yields up after last week having a pretty significant rally across the board, just about a basis point for 2 10s and 30s. Anne-Marie, we do get 2-year auction tomorrow, $69 billion, 5-year auction, $70 billion coming on Wednesday, and 7-year notes coming out, $44 billion of them on Thursday. You pointed to a number of estimates talking about the concern under either Biden or Trump if we get some sort of deficit expansion. And that's one reason, especially ahead of Thursday's debate, that I think some of these auctions might be pretty important.
Yeah, and you have the Committee for Responsible Federal Budget this morning putting out that they're going to be tracking all of this, what these candidates say regarding spending and what that could mean for the deficit. The issue is whether or not it's Biden or Trump. I don't know how many times I'm going to say this, but the deficit is going to rise next year, especially when they're going to have a massive tax fight in Washington, D.C. And it's why more people are coming along to your side, Lisa, and they care about the auctions.
They do care about the auctions, but then they look over at France and they say, just kidding, as the European auctions say, hold my beer. Meanwhile, what you do see in the currency market is a little bit of backing away from dollar strength, both when it comes to the euro region as well as versus Japan. Here we're talking about retracing some of the weakening that we saw from last week, higher by about 1/3%, 107.30. The U.S. Japanese yen cross, to me, and Danny, you pointed to this earlier, is fascinating. The idea of dollar weakness versus yen strength, marginally so, coming after the release of some Bank of Japan meeting minutes, highlighting the interest in even raising rates again, just to stave off some of the weakening and amid warnings of intervention.
Yeah, throwing literally everything at the wall, and it does not work. The yen is still stuck around 160 per dollar. This market wants to see rate hikes. They don't want to see talk of rate hikes. They actually want to see it. And I'm sorry, it only just got pushed back after the last meeting where they didn't do anything with their bond purchase program in terms of laying out details. So the market says, great, we didn't get details. We're going to need to get those first before you hike. So we're just going to wait. We don't care what Conda says about intervention now.
I wonder how much pressure there's coming from people who are sick of seeing American tourists. And they say that the longer that the dollar remains strong, the more tourists we're going to see. Come on, Bank of Japan, get going. All right, under surveillance this morning, another reckoning for Boeing. Reuters reporting that U.S. prosecutors are recommending that the Department of Justice bring criminal charges against the plane maker. Those charges would be related to a violation of a settlement related to 2 fatal crashes. beyond an original 2021 fraud conspiracy charge. It just gets worse and worse. Sources are still not specifying which criminal charges the DOJ could be considering. Amish, you're talking about this earlier. Just, how far can the Department of Justice go, given concerns about financial viability, given the fact that this is the preeminent playmaker of the United States?
Too important to fail. We've talked about this a lot on this program. George Ferguson, when he was talking about with whether or not the DOJ could almost force Boeing to basically say, yes, we're guilty, optically, it's bad, but to his point, the damage is already done. So two potential things we can see, and Reuters talked about this. Of course, there could be financial penalties, but also a third party to come in and monitor what the company is doing, and if they are complying. You'd have to think, why haven't they actually done that already?
Yeah, how many months has it been now? 9 months or something since the latest?
Too many.
Yeah. But a number of years also from 2018 and 2019. Meanwhile, TikTok's parent company ByteDance and chip designer Broadcom are in talks to develop an advanced AI processor. Sources familiar with the discussions say that the proposed 5-nanometer purpose-built chip would comply with U.S. trade restrictions on China. The two companies haven't yet reached a deal. If they do, the chip would reportedly be made by TSMC. Danny, to me, this is a fascinating story because everyone's talking about geopolitical risk, the idea of cross-border insulation when it comes to artificial intelligence in the tech world. And then we see Broadcom partnering with a company, an entity that's supposed to be banned in the United States if senators have their way. How do we make sense of where some of the currents are and how this really factors together?
It definitely feels like a Broadcom that's being careful. They're carefully crafting this deal so it can fit within U.S. regulations. When they announced that they had a new chip customer, they didn't say its name. To me, Lisa, this really speaks to the fact that these chip makers, they just need more diversification. I mean, if you look at who their customers are, they are so concentrated in the big U.S. tech names. NVIDIA has this problem. I think 20% of its revenue comes from Meta. So maybe you kind of skirt around some of these trade restrictions just to kind of help the diversification of the revenue so you're not caught out if Meta one day turns around and says, we're going to curb some of our AI spend.
That's exactly right. When these export controls came out from the Commerce Department, they're very narrow. So it's certain chips that these chip makers cannot sell to China. So what Broadcom is doing is, okay, if these are the parameters and the red lines, I'm going to build around that to make sure I can still supply the likes of ByteDance and potentially other companies in China. It reminds me of what a lot of people say about sanctions. Sanctions don't necessarily work, they just create new markets. Well, these export controls, they're working for some, but they're also creating new markets.
And so then the issue just becomes stability of some of these policies to make sure that the new markets can consistently move forward. Meanwhile, investors are looking ahead to a busy week, including a lot of Fed speak, as well as earnings from FedEx, Micron, and Nike. We'll also get data including consumer confidence, new home sales, another GDP reading, and that key PCE deflator that the Fed looks at so carefully. Joining us now, Bloomberg's Michael McKee. Mike, what are you most tuned into this week?
Well, there is more Fed speak, but it's not really going to be decisive at this point because we're waiting for data that would make a difference to them. We get that on Friday. So the PCE index for inflation is going to be the highlight of the week. The problem is we already kind of know what it's going to be because after you look at CPI and PPI, you can plug in the numbers, and economists generally get that one pretty much on the screws. But if we get that, that's just more evidence that we move forward. I don't think the bond market moves a whole lot on it because this is basically priced in. I don't think that any of the Fed speakers are really going to move the needle at all this week, and they didn't last week. We are just kind of in a holding pattern right now. It will be interesting, as you were talking about with Emery, to see what happens with the auctions because we've had mixed results. We had a couple of tails, and then all of a sudden the last two auctions stopped through, and there was more demand than anticipated. People are still buying U.S. paper. And that's kind of the question about all this is what's anybody in the bond market, what's going to make them care about something?
Maybe it's their summer holidays when they want to go away and don't want to be participating in this market.
That's the bad part about PCE on Friday. It delays your departure for the half.
Well, the good news is, as you say, we already know likely what it will be. So what are we expecting?
Well, we're expecting it to go down on a month-over-month basis, the headline to be unchanged and the core to go down 0.1%, which will push the headline number down to 2.7 and the core to 2.6. And you're getting closer and closer to the Fed's target of 2%. And if you just sort of extrapolate it out, you could see them easily cutting rates by the end of the year. Then the question is just how much do we move between now and then? Does it bring September back into play?
Michael McKee, stay close. Thank you so much for that. We'll be talking throughout the week right now, just to get a sense of how to frame the week ahead and the path of rates going forward. Joining us, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur. Stephanie, I want to start with you. We've been talking about the auctions. We've been talking about concerns about higher rates, but you think that actually rates are expected to go somewhat lower over the next couple of weeks. Why?
Yeah, so we're looking for the 10-year rate to fall towards 4%, and then it could trend again higher when we start talking about the election and concerns around the deficits. But in the next couple of weeks, we could start to see just a continuation of the softer economic momentum. We've seen that in the past couple of prints, and that has brought 10-year rates back down to 4.26, which is certainly lower than many folks were expecting. Many folks were expecting rates to get to 5% before they come back down. But we've just seen that softening in economic momentum, partially because there is actually a genuine deceleration in the economy. Also, seasonals tend to put downward pressure on both inflation and growth in the summer months, and we expect that to be the case in the next couple of prints, which will bring certainly growth expectations back down a little bit. And then inflation should continue to miss. So yeah, core PCE should come in something around 0.15% in the next print. We expect that for the next couple prints, which should allow the Fed to be able to cut in September.
And then after that, there could be something of a sell-off, a slight one at that, but still some modulation there from there. Vishy, what about you? Do you agree with that, that basically the data is cooperating with the bond market, cooperating with the auction schedule to allow yields to continue their decline?
I think the broad contours of what we expected are very much in line with Stephanie on there. I think the economy is clearly showing signs of deceleration, which we had expected. And it's deceleration, but not falling off the cliff. And we also, as Mike talked about, we expect core PCE will not be a big surprise on Friday, and we expect to see month over month 10 basis points in the core PCE numbers. All of that pointing to a deceleration in growth, a deceleration in the pace of inflation, setting the stage for a September cut.
So how much confidence in you have, Vishy? It sounds like a lot, but just gut check me here if it's true that we've seen the peak in yields.
I think in the near term, I think we are fairly confident on the trajectory of the path of inflation over the next, call it, rest of this year, the next 3 to 6 months. We have a very high degree of confidence that inflation will continue to decelerate, and we probably have seen the spikes in rates. I mean, the slight difference of view from the other speaker is that we think that we've been in a fairly in a range that we are really at the tight end of the range. So. Tactically, at this point, we are neutral, pending how the debate and the fallout from the debate will turn out. So, but over a longer time frame, our expectation is that rates will be lower. Our 10-year expectation is that the 10-year Treasury by second quarter of next year, we expect to see to 3.75.
Well, disagreements is what makes a market, luckily. Stephanie, first of all, I have to give you immense credit for this wonderful pun, now OER never, which is excellent. So you actually expect some of the OER to come down. Finally, we've been waiting for this forever. The lag that feels like it's never showed up. So you think that will finally show up in June? Why?
Yes, the June print is the time we're actually expecting it. We haven't been calling it for any particular month until this one. So this isn't necessarily a boy who cried wolf situation. So the reasons for this is twofold. One, the seasonals go the other way, very much so in the first half, and then June it flips. So we should have seasonal downward pressure on OER by a number of basis points. And then on top of that, there was a funky surge in the New York region, which contributed about 12 basis points to overall OER, which is about 10 basis points more than normal. So that should also put downward pressure because that's likely to go in reverse. BLS had put out some comments that it was driven by some noise within the region.
So we're talking about the next couple of weeks, the next couple of months, because that's all that we can talk about. Beyond that, it starts to get very difficult to really have any visibility. And it raises this question, like what we were talking about earlier with Seema Shah principle, that if you do get a Fed rate cut, that could potentially reignite inflation, particularly in the housing market. Stephanie, I want to get your thought on that first. Do you believe that based on how much pent-up demand there is and the likelihood of any increase in affordability will unleash a flood of interest?
Yeah, I mean, this time there's an argument to be made that it could actually be disinflationary. That's not necessarily our call. Our base case is that it'll probably be more neutral for housing prices generally than many expect. The reason is because all of a sudden you're going to unleash a lot of supply. So yeah, the demand is still there, but now you're going to get a lot of supply of existing sales because rates are coming down, and now it's a little bit more attractive than certainly it was when mortgage rates were above 7%. So you actually might get a more normalization in the supply-demand imbalance that could actually keep prices somewhat stable.
I mean, this is an argument that we've heard, right? Which is it disinflationary, inflationary, and everyone seems to disagree. And Vishy, I guess that this is a reason why it's hard to even gauge what's the bigger risk right now. Is it a potential reinflation if the Fed cuts, or is it a potential hard landing recession? I don't have a clear answer, and frankly, it seems like every investor who's come on this show has a completely different take on this. So where do you stand on this? I mean, which is the bigger, more compelling risk?
I think there is a whole host of uncertainties ahead of us. So we have a pretty clear path for the next 6 months or so that the shelter inflation that Stephanie was talking about will continue to decelerate. We get to the same answer as Stephanie does, perhaps in a different approach. We look at all the leading indicators in the rent index, the Cleveland Fed's rent index, and there is a clear lag, and that will begin to hit for the next few months. So, I think a lot really depends on what happens after. I don't think a Fed cutting in September will unleash enormous amount of supply into the market. We expect to do some supply. So we think that the pace of home price appreciation will slow from about 7% where we are now to end of the year. Our base case is about 2%. It is still positive, home price appreciation, but that pace will slow. But we should not forget that there is a huge range of uncertainty of outcomes of elections and a larger range of uncertainty of the outcomes of the elections. So all of that is very much front and center. So I think there's a lot of noise, and it's tough to decipher signal from noise. But what we do clearly see is over the next 3 to 6 months, this inflation is clearly on a decelerating mode.
And we're going to hear a lot of political noise this week, especially when we have this debate on Thursday. Stephanie, you write in your note, the first year of a Biden versus Trump administration may look more similar than many expect. Why?
So 2 things. People are worried about Trump cutting off immigration, and he will very likely cut off immigration flows, especially humanitarian parole, which is adding about 75,000 per month. The thing is, the labor market might be in much better balance by the time we get to the beginning of next year, that we don't actually need all of those people. That might risk putting upward pressure on the unemployment rate. So it might not actually be as inflationary as many folks expect. And then the second is, of course, on tariffs. And our base case is that the tariffs wouldn't go into effect until late 2025, maybe early 2026. So the inflationary forces of the difference in administrations might actually not pan out next year. Come 2026, of course, if we get tariffs, that would be a dramatic game changer between administrations and for sure. But for the first year, it's actually likely the economy might look fairly similar under both administrations.
The economy might look similar, but the rhetoric will certainly look different. Vishy, how are you looking at the election and how the impact could be for markets? Stephanie brings up 2 good points, immigration and tariffs, and what happens with those we might not actually see till 2026.
So we might not really know what how to think about the elections much after that. What I would like to think about really is what are the products within, especially in the fixed income space, that will perform in either case. That puts us in the range of spread products broadly. So by spread products, I mean public credit, private credit, securitized credit, mortgage-backed securities. We see, as long as you take out that the next move by the Fed is not a hike, as long as we are clear about that, in the timing of the arrival of timing of cuts, how many cuts we'll get when they arrive, and the future course of the various policy options probably matter a little bit less to the spread product universe. So that's where we think that the best opportunity lies.
So just real quick, Vishy, what do you think will be the low that we'll see in the next 6 months for the 10-year?
I think we'll get to close to 4%.
So you guys both are on the same page, about 4%. All right, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur, thank you both so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. President Joe Biden taking on Donald Trump over the topic of abortion in a video released this morning, as today marks 2 years since the Supreme Court overturned Roe v. Wade.
Decades of progress shattered just because the last guy got 4 years in the White House. We know what will happen if he gets another 4. For MAGA Republicans, Roe is just the beginning. They're going to try to ban the right to choose nationwide.
Trump has said he believes laws over abortion should be left to the states to decide. The topic is almost certain to come up at the first presidential debate on Thursday. A hack disrupting thousands of car dealerships in North America is in the process of being resolved. Software provider CDK Global giving the update after auto retailers have faced days of disruptions. CDK is one of only a few providers of the technology used to track auto sales and services. Bloomberg reported on Friday that hackers were demanding tens of millions of dollars in payments. And Meta has held talks with Apple about integrating its generative AI model into Apple Intelligence, according to people familiar. The Wall Street Journal reporting that Meta and other companies developing generative AI are hoping to take advantage of Apple's massive distribution through its iPhones. When Apple Intelligence was unveiled earlier this month at the company's Worldwide Developers Conference, OpenAI's ChatGPT was announced as the company's first partner. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. The conversation here continuing very much so about particularly the housing market, just the idea of which is it? And I think that, Anne-Marie, you raised a great question. So which is it? Is it disinflationary? Is it inflationary? Is it going to be something where housing prices are going to finally go down for some people?
I think it comes down to those people sitting on a 3% mortgage rate that have been wanting to get in. Do they see a cut and they think now's the time to move, been trying to upgrade? And how many of them are there that come in and release some supply?
Yeah, well, and also what's pricing like, right? I mean, if prices are the same as where they are, it's not as if affordability is getting any better. Up next, setting you up for the day ahead, you are watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
About 38 minutes to the start of the trading down, counting you down to the opening bell. Here is your trading diary for the week ahead. San Francisco Fed President Mary Daly speaking at 2 p.m. Eastern. Tuesday, we'll get consumer confidence data, plus more Fed speak from Bowman and Cook. Wednesday, new home sales. Maybe we can figure out more about the housing market then. Thursday, durable goods, plus another round of jobless claims. And on Friday, the PCE deflator and our favorite indicator, University of Michigan consumer sentiment. Meanwhile, you do have the first U.S. presidential debate on Thursday. Voting in France this weekend. And the question isn't just what this means politically, but meanwhile, you do have the first U.S. presidential debate on Thursday, voting in France this weekend. And the question isn't just what this means politically, but also what it means for markets.
The stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You know, you all talked about, sadly, it's politics, but, you know, politics and U.S. political stability, you know, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it. That's starting to be tested now, not just in the United States, but the UK, France, and beyond.
That's the reason why, as much as I didn't really want to start the show on politics, Anne-Marie, like that really is one of the most important aspects of this week, given especially what we saw in the French market.
Paul Donovan this morning from UBS, politics sadly in focus. Sorry, Lisa. This week has a lot of politics in it, and markets, he says, are rarely that good at pricing political risk. The U.S. presidential debate may make investors pay attention, and because it's brought up in the calendar space so much earlier than we ever expect, markets need to start paying attention to it a lot more now than they usually would historically.
And just to be clear, it's not that I don't like politics. It's that you can't really get an edge or say something that really is going to be insightful in a way that can be predictive from a market perspective about politics at such an unpredictable time. And that's the reason why there is a sort of feeling in markets watching it carefully, but you don't really know what to do with it. I mean, to me, Danny, that's one reason why I find it fascinating that so many people have just hid out almost in big tech, saying this is sort of agnostic on the political cycle and on the economic cycle.
We're just speaking with Vinu about where you find safety. I mean, he's like, look, consumer staples, they're not a safety trade anymore. The consumer is squeezed. So if you're worried about the economics, you're worried about the politics, you're worried about Europe, because that's a mess, the only place I have to go is big tech. That's why I'm really interested to see whether this week the weakness lasts or not. I know Nvidia's down again this morning, some 2%. Small caps are doing better. What happens if the big tech trade is taken out? Where do I go? I am not certain that I can go to my small caps, I can go to the economically sensitive sectors and get any sort of juice when we just don't know where this economy is headed.
Which is a reason why heading into Friday is going to be so interesting. And the idea of PCE deflator paired with University of Michigan sentiment coming at kind of a crucial point of view, especially with all of the politics.
Absolutely, because inflation and the economy continue to rank #1, not just on this side of the pond, but also when you look at some of the polling in France, and potentially the reason why Marine Le Pen's party may do well is because people in France trust the right wing a little bit more now when it comes to the economy. But Lisa, I was really struck by the Torsten Slok note you brought up. This fact that inflation expectations are becoming unanchored, and we're seeing this diversion depending on where you sit on the socioeconomic scale.
That to me, again, inflation expectations becoming unmoored among people with less income who are actually seeing it that much more in cold relief in the grocery store, in auto insurance, and other expenses. Coming up tomorrow, we've got Sarah Hunt of Alpine Sachs and Woods, Morgan Stanley's Mike Wilson, PGIM's Greg Peters, and Nuveen's Sarah Malik. From New York, this is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Matt Miller. We're looking at futures that are pointing slightly lower as NVIDIA falls in the pre-market. The countdown to the open starts right now. Coming up, futures are flat as investors await the latest read on inflation this week. Political risk is also in sight as Trump and Biden gear up for their first debate on Thursday. Plus, how much upside is left in this bull market? We'll bring you the results from our latest investor survey. But we begin with the big issue. Is the market rally starting to broaden out?
It's difficult at this point, though, to look across and say, right, we need to have a broadening in the rally. But that broadening in the rally can only take place if there's still a sturdy economic backdrop. Now, we are generally quite positive on it, but we are hearing more and more clients actually really worried about the economic backdrop. Real concerns starting to creep in to the point that actually when we think about risks, or we're hearing about risks, we're hearing more about what's going to happen with a hard landing than with an acceleration.
Joining us now is Keith Lerner, co-CIO and chief market strategist at Truist Advisory. And Keith, I got your note a couple days ago that you were downgrading tech from an overweight to a neutral. I have to say that my jaw dropped. Did that take courage?
Oh, good morning, happy Monday. It does take courage because there's so much momentum, but the reality is this. We've been overweight since November. It's up 40% since we upgraded to overweight. It's outperformed by about 15%. And as we looked at the data, we're very data-driven. On a one-month rolling basis, it outperformed by about 11%. You have to go back about 20 years to see tech outperform that much in a month. And most of that last move up was a valuation expansion and sentiment. So that was different than most of this rally has been more earnings-driven. But I also want to be clear, like, we're still positive on tech longer term. We just think on a short-term basis, it's got extended, and we don't think this is the place to chase it after that strong outperformance.
I just want to give credit where credit is due, Keith. I mean, it looks like you're making some really smart calls. You upgraded stocks back in April. We're up about 10% since then. You downgraded tech a couple of days ago. We've seen, at least NVIDIA is down, maybe for the third day in a row today if it drops in the cash trade. What is driving these decisions? What's the data that you're looking at?
Yeah, well, first, I appreciate the good calls. As a strategist, you have good calls and bad calls. I would say in general, our process over market cycles has proven to work generally. And we look at the weight of the evidence, and we look at things like earnings momentum. So right now, one thing why we're still somewhat constructive of the market longer term, even though we expect more of a consolidation, is earning trends are moving up. We think the economy is still relatively resilient. But we also look at things like sentiment. We look at relative performance as well. So what we try to do in our work is when we start to see the evidence kind of tilt less one way, we try to bring in positions, or like in April, at the end of April, sentiment got stretched to the downside. We had a nice correction. We looked at historical data saying the average correction is 5 to 10%. So when we got down 5%, we said that was good enough. So again, it's we have a lot of humility with the overall market, but our process is our guiding light.
All right, I want to get back to this, Keith, because obviously, if you don't think tech's in the leadership, but you're still bullish stock, somebody else is moving into that prime position. Right now, though, I want to get to Mike McKee because investors are looking ahead to Thursday when we get the Fed's preferred inflation gauge, the PCE. He's Bloomberg's chief economics and policy correspondent. Mike McKee joins me on set now. So, Mike, what are we watching ahead of this really big week for political activity, but maybe not for data?
Well, we could see a big trade on the political activity if there's some kind of performance by one candidate or the other. But otherwise, it gets back to what Seema Shah was saying at the top of the show here, that investors want to see the economic climate for going forward. And we have a new Bloomberg survey that suggests not bad, not great, not bad. The latest survey just out now for the GDP numbers for the year. They see 2%, down from 2.2% in this quarter, and then 1.6% going forward. So not a lot of change there. The change comes in consumer spending drops off a bit, business spending drops off and comes back. So it kind of leaves us about where we are. When you look at inflation, the question you asked, Matt, the PCE, economists think it's going to fall in the second quarter and in the third quarter, maybe go back up a little bit in the fourth quarter. But if you're talking CPI, goes the other way. And then employment. Employment is going to slow as the year goes on in terms of jobs created, but unemployment stays about where it has been. So the bottom line from economists is that we're not going to see a recession this year, but we are going to see slowing growth. Now, you can figure out with your guess how people are going to trade on that. In terms of this week, you mentioned the political debate on Thursday night. That leaves us to the analysis of it on Friday, and the PCE, which comes out for the month of May on Friday. Now, after PPI and CPI, economists have plugged in the numbers. They're usually pretty close on this, and they do expect an improvement, which would be good news for those who hope for an earlier Fed cut. Rest of the week, there's some Fed speak. Don't know that it's going to make a lot of difference given the fact that data is driving everything these days. Maybe the Case-Shiller home price index. People are watching housing, but also tonight we have Game 7 of the National Hockey League Stanley Cup Finals, and it's June 24th. So you've got that coming up as well.
Florida has a fourth chance to win the Stanley Cup.
Yes.
And what an exciting game. I'm definitely tuning in for that. Mike, thanks very much. Michael McKee there talking to us about the economics that we're going to be watching. And Keith Lerner of Truist Advisory is still with us. Keith, I want to get back to that leadership position. If, at least for the time being, you're downgrading tech to a neutral, who takes the baton and leads stocks forward, because you're still bullish the overall market?
I am, but I think shorter term, after that kind of that upgrade in late April, we're looking more for a choppy kind of consolidation period for the overall market. So I guess on a shorter term basis, we're a little bit less, maybe less bullish. But the reality, markets typically move 2 steps forward, 1 step back. And, tech's up, 28% this year. There's only 2 sectors outperforming. I think, as far as the sector positions that we have in overweight right now, is still communication services. So that's still more of a growth sector, but it's a kind of a different composition as you think about the Metas and the Alphabets of the world. And we also have that offset with utilities, because we just think it's going to be a bit of a choppier market. So I think it's more of a little bit of patience right now. I don't think that this market's going to rip higher from where we are right now. I think it's going to kind of have an internal rotation. I do expect that, all year long, people have been waiting for a broadening theme. I think there might be some more convergence, meaning if tech's going to consolidate a bit, maybe some of these other areas start to do a little bit better shorter term, like the financials, like the industrials, like energy. But again, I think there's going to be more of internal rotation. It might be frustrating for both the bulls and the bears near term. Ultimately, we think this market still has legs because the average bull market, or the median's over 100%. We're about 50% in, and we don't see recession risk over the next 6 to 12 months. So we ultimately think it moves higher, but again, a rest after this move up is our call.
So by the way, when you're talking tech, you mean specifically the hardware makers, the S&P industry group, INFT, which is, like computer and chip makers, as opposed to communication services. I still think of them as tech. Facebook and Google, it's more than just T-Mobile these days. But you think the big hyperscalers, you're still bullish those companies?
Yeah, well, when you look at the S&P technology sector, I mean, the biggest holdings in there, again, I'm not having individual rankings on them, but like, you have Apple, NVIDIA, Microsoft are the top 3 names in there. So we just think, they've been driving the gains this year. They're big cash flow machines as well. But we just, again, after you've had the biggest outperformance on a 1-month basis for the last 20 years, and the big part of that last move was an increase in relative valuations. And then you look at things like the equal weight S&P, which was down on a relative basis about 5%, small caps down about 7% on a relative basis. We just think there's going to be probably a little bit of that rubber band coming in for tech, and the other areas kind of moving up, some kind of convergence. So maybe a little bit of a broader theme. But as we have that kind of choppy period longer term, we would be using any weakness to actually have an opportunity to get back into tech. We just think it's due for a breather, and we wouldn't be chasing it today.
By the way, Keith, Mike McKee was talking to us about the labor market softening, consumer confidence, at least the conference board coming out this week. We're also getting a lot of housing data with house price index coming out, new home sales coming out. He was talking about Case-Shiller. Those are 2 areas, at least consumer discretionary and real estate, that you still want to stay away from. You're still underweight those. When do you see that turning around?
Instead of trying to predict when it turns around, we look at some of the things I mentioned earlier, the way of the evidence. So we look at relative price trends to turn around. We look for earning trends to start to show some improvement. We're not seeing it yet, so we're just going to be patient until we see that. But I will say it's more broadly to the economy. There's an interesting paradigm right now where we have this normalization in economic growth and slowing inflationary pressures. And earlier when we saw interest rates coming down, inflation coming down, that would have been really good for small caps in some of these real cyclical areas. But I guess right now the market's really saying, okay, we're slowing down, but they want to make sure it's not slowing down too much. So we're kind of in this little bit of an odd short-term period. We ultimately think the economy will remain resilient. It's cooling, but not weak. But again, I think that also leads to a bit of a choppy and near-term trade.
Is it still, all about AI, Keith? Over the weekend, I was in Best Buy with my dad, and he was saying, I got to get one of these new computers that's got AI. I'm not sure he fully understands what that is or if they do yet, but that's been kind of the theme of this market, that, consumers are going to have to go out and upgrade. Businesses maybe upgrade in terms of PCs, for example, because of AI. Is that revolution really going to pay out?
Well, I think as far as the productivity gains from AI, I think we're actually very early stage. Now, the one thing when you look at the market, you have to dissect things a bit, right? Semiconductors right now are up 30% over the last month. We all know the NVIDIA story as well. But I think what will happen over time, when you think about like some of these software companies, you'll see incremental gains. In other words, it won't be revolutionary there. They might say, hey, we have some new AI tools, and we're going to charge it 3 or 4% more than we did before. So it will be an incremental benefit for a lot of the software names. But I do think, as you think about it, I was just talking to my wife this morning. She's got an iPhone, and she's looking to upgrade. And I said, you may want to wait till after September because AI is coming out. I just upgraded my phone. I wish I would have waited a little bit because, everyone wants the latest and greatest. So I think it will generate kind of that upgrade cycle, not only on PCs, but also iPhones. So I think this will be the secular theme of this bull market. So again, I want to make sure people realize we're not bearish, but again, you move so much in a short period of time. It's saying, when do I want to deploy capital in a more meaningful way? And right now, we just don't think it's that time. We think we'll have a better opportunity to do so. But we do think the AI theme is the theme of this bull market.
What about the Fed? I can't let you go without asking your take on FOMC policy. Nancy Tangler, I heard this morning on Bloomberg Radio from Laffer Tangler Investments saying she doesn't really listen to the Fed speakers as much as she watches the data, and she thinks, as a lot of people do, that they're going to have to cut more than the dot plot showed they suspect. What's your take on cuts this year and cuts going forward?
Yeah, we were pushing against the market view of 5 or 6 cuts early this year. We now expect 1 or 2, which means we're probably close to consensus at this point. We think inflation is moving down enough for them to cut rates. The one thing I would really say what you want to watch instead of the speakers, watch those weekly jobless claims. They've been inching up the last couple of weeks. If we see another move up in the next week or 2, I think that gives them more ammunition. Our base case is something probably around September and 1 or 2 this year. But I do think, they're still restrictive because even if we argue that the neutral rate is, now 3 or 3.5, it's not 5 or 5.5. So we think it's time to start moving later this year.
All right, Keith, great to get some time with you. Thanks so much for joining us. Keith Lerner there of Truist Advisory with some spot-on calls in this market. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle. Abby?
Well, Matt, you both were just talking about NVIDIA, so let's take a look at those shares, because as you had mentioned, if the loss holds, we will have NVIDIA down for a third day in a row, losing. At this point, it would be on pace for an 8 to 9% decline, the most and the longest since early May, so some of that AI NVIDIA craze backing off, but some of the consolidation around that massive uptrend into last Thursday. The stock had been up 180%, somewhat healthy. On the other hand, Micron, the chip maker, the DRAM and storage memory company, it is up ahead of earnings on Wednesday. Citi is saying it's a top pick, and also some analysts are saying that there's a chance that they will beat the midpoint, and B of A recently came out saying that Micron could be a beneficiary of AI. AI, of course, being the big driver for so many of these tech stocks. And then finally, Alnylam, the pharmaceutical company, biotech company, the medical company, they have a very positive result in late-stage phase 3 trial result to their heart disease treatment. It was positive. The primary endpoint was met. And importantly, that treatment, Matt, does reduce patient deaths and hospitalizations. Those shares soaring.
All right, Abigail, thanks very much. Abigail Doolittle there, talking to us about some of the individual movers. We'll check back in with her later on in the program. Coming up, the latest Bloomberg Live Pulse survey showing investors are getting nervous about the market. We'll break down the results next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night. Bloomberg, top experts, great questions.
Bloomberg releasing the results of our latest Markets Live Pulse survey today. The results showing investors feel the 2024 bull run is almost over. The respondents saying the S&P is the most overpriced asset in the market. Joining us now with the results is Bloomberg's Christine Aquino. And Christine, we were just talking about the fact that if investors are worried, they're probably buying as well.
Yeah, it's interesting, Matt, because in the same survey, of course, we have people saying that they are very worried about the rise in the S&P 500, 31 record highs just this year alone. I mean, how much farther can it really go? But at the same time, when we ask them what is the best trade that you're thinking about for the second half of the year, it is still largely stocks. And so on the one hand, you can see that people are, in fact, getting worried, climbing this wall of worry, but at the same time, they're not necessarily seeing better alternatives out there in this current market environment.
I mean, if you look back at bull markets throughout the last 100 years or so, they roughly double throughout their lifespan, right? And we're only up 50% since the bottom in 2022. So at least Keith Lerner from Truist was saying we still have more room to run.
Yeah, absolutely. And I think we're also entering quite an optimistic period for stocks. We have seen some analysis from Goldman Sachs, I believe, showing that the first half of July tends to be the best performing 2 weeks for the S&P 500. This is based on what, like a century's worth of research. And so you can see that there is quite a bit of optimism in the market at the moment. And it's interesting to see as well that that optimism isn't just necessarily coming from the outlook for monetary policy. It's also coming from the outlook for various sectors, particularly in big tech and the future of AI.
Right. I saw last week, I think, a note from ISI saying that they expect 8% earnings growth this year, 5% earnings growth next year. So you do see, earnings behind the gains. You don't see really high valuations. Yes, they're lofty, but they're not frothy right now in terms of the price to earnings going forward. How do you find investors talking about earnings?
Yeah, I mean, I think it's interesting because there is, again, a lot of optimism in earnings, particularly when it comes to the big tech sector. I think there is a little bit of divergence there between big tech and the rest of the market, right? And this is where we kind of bring in the idea of this K-shaped stock market where a very concentrated amount of companies are enjoying that kind of earnings windfall, while the rest of the sector, not necessarily so. And I think this is where the worry stems from. And ultimately, people do think that they're not necessarily, stocks aren't necessarily going to continue this meteoric rise. They are expecting, a majority of the survey respondents are expecting a 10% correction, but not until 2025.
A correction Mark Cudmore was talking about this morning is expected from him as well. In terms of the broadening out, I guess that's the big question, right? Because we've seen the earnings growth really concentrated in those magnificent 7 stocks. Do the 493 eventually catch up?
Yeah, I mean, great question. And hey, honestly, I mean, it's hard to kind of really see the momentum in this particular sector stalling anytime soon, just because the hype is still very much real. Investors are very much willing to buy into anything related to AI. We've definitely seen that from the performance of NVIDIA overtaking the market cap of both Microsoft and Apple, and then also the related stocks in that sector catching up as well. TSMC, another one of these performers about to crack that $1 trillion milestone. And so, yeah, we're definitely just seeing still a lot of momentum into this trade. I think the question for the second half of 2024 is, I think, like particularly for NVIDIA, it is very much dependent on capital spending from its other big tech compatriots, right? And so it's just a question of, will they want to keep spending on AI tech for the rest of the year and into 2025?
Absolutely. I love the SPLC a screen for NVIDIA, so you can look at all the customers and try and tally up how many billions they're going to spend. Christine, thanks so much for joining us. Christine Aquino there from the MLive blog. Coming up, the morning calls, and then later Ann Berry joins us, Threadneedle founder and partner. She's going to tell us where she sees opportunity to buy the dip and name a few specific stocks that she likes. This is Bloomberg.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while
This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good Monday morning, I'm Matt Miller. This is The Open. We're looking at futures slightly down on the S&P and the NASDAQ as NVIDIA falls for a third session in a row. Time now for some morning calls. Look at some of the analyst recommendations on Wall Street this morning. First up, Citi is upgrading Carrier Global to a buy. The firm says the company, which makes air conditioners, is well run and sees room for further upside in this heat wave. Next up, Goldman Sachs initiating coverage of IBM with a recommendation of buy. Goldman believes Big Blue is on a path to successfully complete its pivot to long-term growth. And finally, Citi, again, cutting ResMed to a neutral. The firm is downgrading the breathing machine maker following additional clinical data from Eli Lilly that showed its weight loss drug reduced the severity of obstructive sleep apnea. Again, taking a look at the markets as we see big tech, at least in the shape of NVIDIA, down in the futures market. We see S&P futures down 0.1%, NASDAQ futures down about 1/3%, and Russell 2000 futures actually up about 0.1%. Can small caps come back? Can you see it broadening out if you lose leadership from NVIDIA? It's lost over the past 3 sessions. If it does fall today at the indicated level, about $300 billion in market cap. If you take a look at what's going on in the bond market right now, there's a lot of questions about what will come out of the Fed, what will come out of PCE. We were talking about that with Mike McKee a little bit earlier. You see the U.S. 10-year yield right now really unchanged, but at 4.25. It's been as high in the last couple of years as almost 5 and as low as 3.80, so right in the middle of the range there. And if you take a look at the euro, you see real questions about what's going to happen in France. The French go at the end of the week to vote in the first round of elections. The euro had been bouncing back and forth between 108 and 107 after that snap election was called. Right now it's 107.38 and on the rise, but the question is, can that weaken more if the far right wins the first round of voting, and will they go on to win even possibly an absolute majority in terms of the total parliamentary seats there? That could really throw into question investors' commitment to European debt. Coming up, Ann Berry, Threadneedle founder and partner, joins us. She's going to tell us how she's navigating what she calls an expensive market and talk to us about a few specific stocks that she likes. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading and seeing soft futures on the S&P 500, down but just by 0.04%. NASDAQ futures falling further as NVIDIA is down for the third day in a row. The chip maker on track to lose $300 billion in market cap over the last 3 sessions, or last 2 plus 1 if they continue to fall today. One stock to watch at the open is Coinbase, falling alongside other crypto-related stocks. For more on that, we're joined by Bloomberg's Abigail Doolittle. Abby?
There has been some real weakness for this crypto space, Matt. Last week, Bitcoin fell more than 4%. Its second worst week in 2024. And we, of course, have had Bitcoin in a bit of a range for much of this year, basically trading between about 60,000 and upwards of 70,000. Right now, heading down toward those important support levels. I would argue if 60,000 holds or thereabouts, we'll probably see Bitcoin bounce back higher. The next level to watch below 60,000, around 56,500. And this, of course, is a very technically driven market. If that level were to fall, we probably will see Bitcoin fall very quickly back below 40,000 or even to $30,000 per Bitcoin toward the long-term uptrend. Bitcoin over the last, let's call it 6 years or so, has done that 1, 2, 3 times, some consolidation of that bullish long-term uptrend. I would say just from a pure chart technical standpoint, Matt, it does seem very likely that we could have that happen. It may not be right now. It may be after another upswing up and then back down. Something else that I would bring into this mix, Matt, there is some talk that there's a little bit less demand in terms of trading those Bitcoin and the crypto ETFs and some of these related stocks. But another thought here is that Bitcoin a couple of years ago, when it was thought that the VIX was dead, served as a risk-on, risk-off barometer. So right now we have it stuck in a range, but if it were to break down, that could be some tell that some of this bearishness that it seems that some of the managers out there are thinking could happen, or at least that we've hit the peak for the year. Maybe that comes to fruition.
Yeah, I was just going to ask you, Abigail, do you talk to investors who look at Bitcoin as an indicator for the broader market?
So I really don't hear many professional investors talking about that, but it's certainly a narrative that comes out. And it's interesting because many people talk about Bitcoin as digital gold. If that were the case, we would see Bitcoin soaring to new all-time highs right now on fear that maybe we are a little bit overdone in the market. Maybe we are going to see some sort of a rotation into value over growth, that long-wanted rotation. But we really don't see that. When stocks and commodities sell off, both of those are pools of risk-on assets. We also see Bitcoin and the crypto space sell off.
Well, Abigail, I mean, if it's digital gold and you thought there were going to be 5 or 6 rate cuts, you wanted to load up on it. But now that you see maybe there's only going to be one, you let a little of that go.
That's an excellent point for sure. And I think that that's a piece of what we've seen with actual gold. That's a great point, Matt.
Abigail Doolittle, we'll get back to you in a little bit. Right now, I wanted to get over to shares of NVIDIA extending their losses this morning. As I said earlier, on track to wipe out nearly $300 billion in market cap. I think we've already seen $220 billion go over the last 2 sessions. That just shows you how big this stock is. Bloomberg Technology co-host Ed Ludlow joins us from the West Coast with more. So, Ed, what's the story with the chip maker?
Yeah, I think the story is the concern over valuation and how far we've come on NVIDIA. You're right, we're down for a 3rd straight session, down more than 2% as it stands. The first time we've had a run of 3 straight days of decline since May 9th. You will have seen what was probably the most read story on the Bloomberg terminal and Bloomberg.com over the weekend, which is whether you're on the sell side or the buy side, a lot of people are having trouble forecasting or predicting top-line growth when it comes to NVIDIA because they're growing at such a rate. You know, the story makes the point that NVIDIA is the most expensive stock on the S&P 500. But if you look at it as a price-to-sales ratio issue, it's trading at 23 times forward 12-month sales. It's really hard to do the math. They used this starting point in the story of the April quarter of last year, 2023, which is when this really explosive top-line growth started happening. And even against the company's own next quarter forecasts, since then, every quarter, revenue has come in about 13% greater on average than the midpoint of the forecast that management gave. That's kind of the math and markets and analysis side. On the product side, NVIDIA's in this really interesting situation where it commits to bringing a new generation of AI accelerator to market every 12 months. And the concern for some is that, well, hold on, you have this big backlog of business and supply constraint is a big boost to you. But if you keep bringing in new technology, won't you have a really big pool of frustrated customers who say, hold on, I've just waited 2 years for the H100, and now you're telling me that your latest AI accelerator renders the thing that I spent so much money on obsolete. And Jensen Huang's answer to that has always been, oh, it's really easy to swap them in and out. So it's an interesting story. The stock had opened down 3% 30 or 60 seconds ago. We're now down 2%. And I think we're going to be having this conversation every day for the next 6 months, probably.
Yeah, absolutely. Nonetheless, it's a great day to tune into Bloomberg Technology. Ed will be co-hosting that show with Caroline Hyde, so tune in at 11 a.m. Eastern Time. Some M&A news this morning with RXO agreeing to buy a UPS unit for $1 billion. Bloomberg's Alexandra Semenova joins us with more.
Good morning, Matt. Well, UPS said that the goal of selling its Coyote Logistics business to RXO is so that it could focus more on its core shipping business. The move comes about a decade after it purchased Coyote Logistics for $1.8 billion. It's now selling the unit for just over $1 billion. The purchase makes RXO the 3rd largest broker transportation provider in North America. The deal is, of course, subject to regulatory approval and is expected to close by the end of this year. UPS said that it will update its financial outlook when that transaction is finalized. UPS Chief Executive Carol Tomé told analysts during its 4th quarter earnings call that the business had been a drag on UPS's bottom line with a very low margin and the revenue way down since the COVID-19 pandemic. RXO shares are up about 14%. That's the best move on record. UPS is little changed and a pretty positive reaction from Wall Street on this deal. Barclays says that it looks favorable from a valuation and commercial perspective for RXO.
All right, Alexander, thanks very much. Alex Semenova there talking to us about some M&A action. Joining us now to talk about the market and some individual stocks, as well as Ann Barry. She is Threadneedle founder and partner of Threadneedle Ventures. Ann, thanks so much for coming on the program. Let's talk first of all about the slight pullback that we're seeing in NVIDIA. I guess it's not necessary for NVIDIA to continue to rise for the whole market decline because a broadening out would do a great deal. But it does seem to be the bull case for most.
I think it is a bull case. I think the little pullback we've seen is a bit of profit taking, to be honest, Matt. And don't forget, there's always in the back of people's minds, when are there going to be competitors coming out with new chips? You know, we've got a lot of big names going after it. So I think when people get nervous,
they take a little bit of money off
But
the
it's a
table.
long way off, right? I mean, everyone we talk to says the
Yes,
second best
absolutely.
performer is far
Yes.
away from what NVIDIA's chip
Yes.
technology can provide. So what do you think about this market continuing to run? I mean, we had an MLive survey saying a lot of investors are nervous about it. To me, that just says we can continue to climb a wall of worry.
Look, I do think it's an expensive market. I've been saying that for a while, and yet it continues to go up.
Expensive in what
Expensive,
terms?
well, if you look at the equity risk premium, right, it's still extremely small relative to historical levels. In a world where we still have a lot of uncertainty, to your point on this MLive survey, consumer sentiment is starting to wobble. We'll see more data coming out on that this week. One big canary in the coal mine stock I'll be looking at this week, Matt, though I don't trade in it, is I want to hear what FedEx has got to say about demand. You know, that has typically been a bellwether stock for trying to get a sense of what the macro outlook has been. So I think there is some uncertainty out
Yeah,
there.
I think there is definitely concern about the consumer. That's what I hear from the investors that I talk to. The housing market, the real estate industry still has big problems, and yet people continue to be bullish. Julian Emanuel from ISI last week came out with a target of 6,000, raising it from 4,750. So it does seem like there are very few, at least strategists at big banks, concerned enough to be bearish this market.
Well, I think that there are a couple of things driving that really big target that you just mentioned, right? I think people are saying, look at where the market is now before the rate cuts have even come into fruition, right? So if you look at tech in particular, if you look at the growth stocks, if they're sustaining these valuations now despite uncertainty, what is it going to look like when rate cuts get real, right? So that would be a driver to the upside. The other thing is, too, when we look at the Fed balance sheet, when we look at liquidity, there is still an enormous amount that's continuing to push into the equity market, which, by the way, Matt, is only going to get bigger if this deficit, the national deficit, doesn't get under control. So I think there's that element, too, of there's still going to be a lot of cash coming into the market over the long run.
In terms of some tech stocks that have lagged behind, Salesforce is one of them, CRM. What do you think about this stock? You have it in the three names that we're going to be talking about today, and I imagine you think the 10% drop or so that they've had this year is a good point to get in.
To me, it's been a buying opportunity. If you look at where it's valued on an EV to sales perspective, if you look at it in terms of its profitability, I happen to think as Salesforce continues to execute, and execution is the name of the game, against integrating Slack and other acquisitions, against getting operating leverage, as it continues to push ahead with its go-to-market strategy driving growth, I think we can see 200 basis points of margin uplift. And I think this one down the line becomes a dividend yielder. It's not there right now, but it's got a free cash flow profile that would support it at some point.
Well, everyone's talking about the iPhone upgrade cycle benefiting from the small additional AI, tasks they're going to be adding to that. I would imagine Salesforce has the same impetus.
Well, I do think that it's, as a software company as opposed to on the hardware, I do think that Salesforce has that benefit. It's been quite good about talking about generative AI. If you look at how Gen AI has been articulated across a lot of companies, Salesforce has been one of the ones to really point to a specific monetizable strategy that hasn't been true of everybody else.
What about Palo Alto Networks?
I feel like I've become an evangelist for Palo Alto Networks, actually, Matt, a little bit. I've been buying the dip on this one. Palo Alto Networks is going to market with what I think is a pretty aggressive strategy to get new customers. It's offering to eat the cost of getting clients to switch if there are a couple of months where they have to have two providers at the same time to make that switching decision. I think it's a bold strategy. It's executing against it. And when I talk about, when I talk to clients, when I talk to companies about how they think about cybersecurity. What is the strategy they want? They want single providers. They don't want lots of different providers patchwork together, and Palo Alto Networks is coming with a holistic solution that's gaining real traction.
When I saw that name this morning, I instantly thought of Palantir.
Yeah.
Palo Alto is twice the size.
Yeah.
But I just wonder why Palantir doesn't do some catching up here.
Well, it's interesting. If you look at the net margin, right, so net margin of these businesses, Palo Alto's is higher, which is not atypical of a true pure play software business. Palantir has always had this bit of a debate around it, really from the dawn of its existence. Is it a consulting company? Is it a software, a service company? How should it be valued as one versus the other? And SaaS tends to get the higher valuation. Palantir's story is, I think, a little mixed. Big personality in the CEO, though. We were talking about it, Alex Karp. Not far from the headlines quite often.
He made some very interesting comments about the West being the best, with the exception of our universities, which he has a very negative opinion of. We don't need to get into that. Obviously, this is all techie stuff, software stuff that we've been talking about. But I noticed John Deere is another stock that you like. It goes the other way, and they've had real problems with grain prices last year coming down substantially. Farmers have taken a real hit.
Yeah, they have. Look, anytime you've got the kind of commodity exposure that John Deere has. It's never going to be an easy ride. It's going to be bumpy. But if you take a big step back on this one, and I look at this truly over a 10-year view, not a near-term view, I say here is an absolute titan in the ag hardware business and the machinery business. You mentioned earlier, Matt, the Apple iPhone replacement cycle, right? There is going to be an agricultural equipment replacement cycle. It's going to get more pressing. It's going to be more data-driven. And John Deere is the tip of the spear on precision ag, and I think as AI gets infused into that, this is one where you've got a manufacturing business that really stands to gain from it in a very specific and tangible way.
And a stock that's actually fallen as well. Again, a stock that's fallen. This one down almost 6% year to date. So you think it's a good entry point? It's
a good entry point, I think, but again, it's a long-term hold if you're really, really willing to ride out the commodity cycle with it.
All right, Ann, great to get your picks. Thanks so much for joining us. Ann Barry there of Threadneedle Ventures. Coming up, investors weighing political risks this week.
The stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You know, you all talked about, sadly, it's politics, but, you know, politics and U.S. political stability, you know, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it.
That conversation next with so many elections and a big debate coming up this week. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience. But are you hopeful that I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The stakes here, I think, are very high, not only politically, which is obvious, but I think also for markets. You know, you all talked about, sadly, it's politics, But, politics and U.S. political stability, is an underpinning of the market that's been taken for granted so long that most investors don't even think about it. That's starting to be tested now, not just in the United States, but the UK, France, and beyond.
That was Terry Haynes of Pangea Policy speaking earlier on Bloomberg Surveillance. The first presidential debate between President Biden and former President Trump is scheduled for Thursday night in Atlanta. Joining us now with more on the political risk this week is Anne-Marie Horton, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. So it's going to be something everyone will want to tune in for, although it's past our bedtimes, and I would think past theirs as well. Do they make that 9 p.m. start so that people on the West Coast can still watch it at a decent time?
I think so. Also, it's prime time. But I think you're alluding to the fact that it's the first time in U.S. history that the two major candidates for the major political parties are the oldest we've ever seen. So there's a lot of firsts in this debate. Also, the fact
they were the oldest last time, too.
Also, for the fact that this is the first presidential debate that's this early on in the cycle. So this is really going to kickstart all the noise we're going to hear and trying to separate, at least from a market's perspective, what Terry Haynes was talking about there, some of the rhetoric from the policy as we gear up for November 2025.
So what will we see in terms of the major differences? Because a lot of the policies that President Biden has pushed forward, I think of the most recent tariffs, right, or trying to bring production, manufacturing back to the U.S. have been a continuation almost of Trump policies.
Yes, there are some policies where we have seen this administration continue on from what we saw from Trump, basically a handoff when it comes to things like tariffs, or we've seen this administration actually take a step forward when it comes to export controls on China, and when it comes to tariffs. We just had the release of e-tariffs of Chinese imports coming in, EV imports coming to the United States, 100% on those tariffs now. So you'll hear a lot of the same rhetoric potentially on China, but there will be vast differences when it comes to things like inflation, at least from the noise. Former President Trump is really going to want to paint Biden as destroying the U.S. consumer when it comes to inflation. Over the weekend, he pulled out this prop, which you're not going to be able to do at the CNN debate, of a little miniature TikTok and saying this is what it's like living under Bidenomics. And he said he's going to have Maganomics on day one. So he's trying to really tap into what we see in polls, this concern over the economy and inflation. And for Biden, I think one key thing that's likely going to come up, and he put out a new TV ad today about it, is abortion. Today marks 2 years since the Supreme Court decided to strike down Roe v. Wade, and this is something that the Democratic Party really wants to try to instill this concern, especially for women and especially in those swing states.
But at the end of the day, for most voters, it's all about the economy, it's all about taxes, what they actually have to pay out of their pockets, right? How will they differ in that term, in that sense?
Well, when it comes to the economy, this still remains to be the #1 issue, and inflation still remains to be the #1 issue when you ask people their concerns about the economy. And this is something the Biden camp has been trying to explain. Maybe the PCE deflator on Friday will help them. But it's really the issue with the inflation is it's hard to explain that the rate inflation is coming down. People want to see prices come down, and that's not going to happen. Biden is going to come out and call for an increase, likely, he'll say this in the debate, on taxes of those in the millionaire class or the 1%ers, and also raising of corporate tax rate. Trump is going to do the opposite. He wants more tax cuts. 2025, Wall Street Journal editorial is a great op-ed today, actually taking a quote from what Senator Warren told Bloomberg, which is 2025 is tax Armageddon. Tax policy is going to be huge next year because this is when the Trump-era tax cuts, there's a decision that Congress needs to make whether or not they're going to continue them or not. But Biden has said he will not increase taxes on anyone that's making less than $400,000 a year. But these are some of the policy rhetoric we're going to be on lookout for.
Right. The state and local tax deduction is supposed to sunset in 2025, so that's an important issue.
I know you're looking forward to
Well, I think, a lot of people are paying more taxes because of that, certainly in New York. Immigration is still a big issue as well, right? And we saw a flood of immigration throughout the Biden presidency. He didn't really try to make any changes until the last few months. How is he going to win on that issue?
Well, he's going to try to talk about the fact that he thinks what Trump wants to do in terms of immigration. Trump has even talked about deportations. He's going to try to paint that as inhumane. And he wants to remind Americans of potentially some of the rhetoric that unnerves some of the middle of America when it comes to Trump's policies. But what's going to be difficult about this debate is that, of course, it's going to be a lot of noise. You're going to have to really sift through to try to get the policy differences.
Just back from the G7 in Italy, right? You saw how Meloni, I guess, led that. what do you think about the possibility of the far right winning in France? Because it seems like she's doing an all right job in Italy.
Well, I think what Marine Le Pen is trying to do is basically use the blueprint that Giorgia Meloni has set out. Basically, throw enough red meat in this rhetoric domestically, but she's not a Eurosceptic, and be able to, on the international stage, work with all the players. And at this point, it's the people who were saying that Giorgia Meloni, they were trying to outcast her, saying that she's huge Eurosceptic. She's actually now the queen maker when it comes to what's going on in Brussels. This is something you see Le Pen trying to do, but what happens in France, of course, you know that President Macron is still going to be the president. So what you're going to have to see here is cohabitation if we were to see the right do well, which polling shows it looks like they're going to.
I have to say, it's one of the most fascinating stories, for sure. Anne-Marie, thanks very much. Anne-Marie Hordern, the co-host of Bloomberg Surveillance and our chief political correspondent. Let's get back to the markets now for some of the price action this morning. We go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Speaking of fascinating, let's take a look at the sector action, because right now we have the S&P 500 up ever so slightly. Moments ago, it was down. The reason this is fascinating, 10 of the 11 S&P 500 sectors are higher, but it's tech that's down 0.9%. A moment ago, down 1%. That's why you had the index down just a little bit. This speaks to that importance of that rotation everybody's speaking to. Because of the weighting of tech to the index, you can have all 10 sectors higher, but if you have tech down, you can have the S&P 500 up just slightly or down. Speaking of down, we do have the Bloomberg crypto index down in a significant way over the last, let's call it 2 weeks or so, nearly in a correction. Again, perhaps a tell on a risk on, risk off, or as you were making the point, Matt, perhaps around the Fed.
All right, Abigail, thanks very much. Coming up, the market-moving event you need to be watching this week. That's next in our trading diary. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Time now for the Trading Diary, what you need to be watching today and this week. We get the June Dallas Fed manufacturing data in just about 30 minutes' time. Tomorrow, the Bloomberg Invest Conference kicks off here in New York City. And on Wednesday, we get May new home sales data. Thursday brings the first debate between President Joe Biden and challenger former President Donald Trump. We round out the week with PCE on Friday. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fats?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up, we're going to check in on the markets with Vince Signorella. He is our macro strategist here. We're going to talk a little bit about Apple. They got the EU kind of looking at Apple yet again over App Store abuses. It seems like we've heard this before. Laureen Gilbert, CEO of Wealthwise Financial, will give us her market call. Then we're going to get an overview of the restaurant business here in 2024. Michael Halen, he's the restaurant analyst with Bloomberg Intelligence. He'll join us and give us a sense of where people are spending their money in the restaurant biz. But first, let's go to Lisa Mateo and get a Bloomberg Business Flash.
Good morning. Market Drivers brought to you by IBKR. Financial advisors switch to Interactive Brokers for your lowest cost global trading and Turkey and custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. All right, let's go to the markets where now we've got green on the screen. Traders, they're gearing up. We have a week filled with politics, inflation data on the political side. Of course, the focus will be on the first U.S. presidential debate. But on the data side, we'll break it down for you. Tomorrow, the latest read on consumer confidence. Wednesday, we have that report on new home sales. Thursday, we move on to revised first quarter numbers on GDP, but it's all about Friday. We get the PCE inflation numbers, core PCE reading expected to confirm easing price pressures, and that could pave the way for an interest rate cut in September. Right now, we have NASDAQ up about 0.1%, 19 points at 17,709. We have the Dow up 0.6%, 265 points at 39,415. We have the S&P 500 up 0.3%, 18 points at 5,482. The 2-year yield at 4.73%. That's little change. The yield on the 10-year 4.25%, and that is little changed. We'll head over to commodities. We have spot gold higher at $2,300. $329 an ounce. Brent crude, $85 a barrel. WTI crude, $81 a barrel. And we'll take you to retail. Target, they're looking to catch up with the likes of Walmart, Amazon. It's partnering with e-commerce specialist Shopify. They're going to expand its marketplace for third-party merchants. We have Shopify. Their shares up about 0.5%. Target shares up about 2.5%. That's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Happy Monday, everybody.
Yes.
I know this is Paul's like 9th hour of radio, but
Yeah,
it's my
all
first.
good.
So
Very
welcome.
good. We got the stock market higher here today. Again, I'm just going to go back to your analysis. Just wants to go higher.
People just want to buy stocks.
Yeah, there you go.
They don't want to buy Nvidia though. Do you know it's $300 billion lost in market cap since June 18th.
Is that yeah? Okay.
I was looking at the market
Yep.
cap chart. That is definitely something. I know it's going to be a light week, but we have some fun stuff later. You not only have the economic data, but you have the Russell 2000 rebalancing, which we know what's going to rebalance, but the stocks that are leaving the Russell to go to the Russell 1000 will make that divide between small caps and large caps even bigger.
Okay. All
There's
right.
something to watch for that. And quarter end.
Yep.
Quarter end,
Yep.
rebalancing.
It's been a good quarter. I mean, we're up, year to date, 15% in the S&P 500.
So can you blame anyone for selling Nvidia at this point? Let's get more with Vince Signorella. He is a Bloomberg macro strategist. So $300 billion wiped out since June 18th. That ain't nothing.
Dropping the bucket for Nvidia.
Oh, no, seriously. Like, more downside? Like, why the selling? Like, do you think it's quarter end? We've seen inflows into tech, so in some ways this doesn't make a lot of sense.
So, yeah, I mean, tech is a little under pressure. It's a bit wobbly today. It's actually just NASDAQ just gone green, joining the other two major averages. I think you just had this, like, meteoric rise, and the market's taking just a step back, maybe a little profit taking. You get into the situation with NVIDIA where, even the analysts are having a very difficult time calling revenue or future revenue. So it's been surprising to the upside. But it's surprising to the upside on smaller beats. So at some point, do they miss? And that's maybe giving folks a little bit of anxiety about the stock as well. As we noted last week, it was a valuation at one point bigger than both the UK and French stock markets combined. That has to bring the word bubble into mind as, not that the future valuation of the company can't meet those expectations, but maybe the present value of the company is just a little bit too ahead of itself.
What's the risk environment out there? What's the risk appetite out there, Vince, when you talk to traders? How do they see things? I mean, boy, we got a lot of economic data this week, but even longer term, 2024 is an election year. I'm not sure what the Fed's doing. How do they think about risk?
If you looked at the stock market this morning, you would think it would be brilliant. But a lot of the traders I talk to they're anxious. I mean, again, we've come a long way this early in 2024. Fed rate cuts have been pushed back a little bit. And, you really have to question, even if the Fed does cut, the conversation that's going on from the FOMC is one, and then we're going to wait for some time. So you have to wonder what realistically 25 basis points is going to do. Practically nothing when you think we could be 300 basis points away from the neutral rate, probably a little closer to 200, but still far, far away from where inflation is running into where the Fed is. And, as they go at this slow pace, and as we see jobs data coming in slower than, gains in jobs much slower than we have seen, will the inflation come down to match the expectations that the market has of 2 cuts this year, so that the enthusiasm will continue? And that's the anxiety that I think we're seeing. I don't think anyone really expects the Fed to do anything prior to the election, even though they say they're neutral and they're not going to be involved. I don't think they want to be seen as weighing in. Let's just say, for argument's sake, all the criticism Chair Powell has gotten from Trump, if Trump becomes president in November and they cut in September, it's more likely than not that he's going to see that as them putting their thumb on the scales in favor of Biden. So they don't need that aggravation for 2 months. So I would think if they're going to cut, it should probably happen more likely in November.
Yeah.
But again, we have to wait to see what the economic data suggests.
Okay, before we let you go, what is going on with Bitcoin? Getting hit pretty hard. The micro strategies of the world, like all the crypto stocks are getting hit also. It's like Bitcoin and then Nvidia and its peers. Like, that's what's getting hit. What is going on?
I think when you look at the markets in general and how much money there is around the world and where it's going and what are your best options, I think folks are looking at the stock market and the precious metals market with central banks aggressively continuing to buy gold as a better place to be. So it looks like a little bit of a shift in asset class out of the intangibles, if you will, the digital assets, and into the more tangible assets, being equities and gold. And we'll see how long that continues. I mean, the folks around the world seem to think Bitcoin's going to 100,000 at some point. So maybe that becomes a buy the dip soon, but it doesn't look like it's happening anytime today.
All right, Vince Signorella. Good stuff there. Vince Signorella, a macro strategist for Bloomberg News, joining us, giving us an update on the markets. Again, we get a little bit of a positive opening here to the markets here. The S&P is up about 0.3%. The NASDAQ up about 0.1%. One of the pieces of news crossing the tape here, Alex, just recently was, Apple. There's some concerns there. The European Union regulators once again looking at a big U.S. tech company, in this case Apple, looking at their app store and maybe some abuses there. Tamlin Basin joins us here. Tamlin is a technology analyst for Bloomberg Intelligence. He was in the U.S., but now he's in London. How did he get to London? I have no idea how that happened. I did not approve.
I'm hoping a plane. A ship would take way too long.
Yeah, I did not approve that move. But anyway, Tamlin, thanks so much for joining us here. Tamlin, tell us what's happening with Apple today as it relates to the European Union and some of the regulators there.
Yeah, sure. So what happened today is the European Commission announced preliminary findings in an investigation into Apple under the Digital Markets Act. This is the sweeping new competition rules that the European Union just sort of implemented in March of this year. Now the findings of this probe relate to anti-steering rules, so essentially to Apple's rules that it has in place to sort of prevent app developers from informing users of maybe cheaper subscription options outside of the App Store. Now, this might sound familiar because just in early March, before the DMA took effect, the Commission did fine Apple 1.8 billion euros over sort of these same anti-steering policies. Now, what today the Commission said is that Apple is still not complying now with the DMA in terms of really letting developers freely engage with users and direct them to cheaper options. Specifically, this kind of, they want developers to be able to market within the app and show cheaper subscriptions within the app. So really this is kind of more pressure on those sort of app store revenues that Apple.
So what does Apple say to that? Like, what's their defense to that? Because presumably they had months to kind of get it together.
They did, and they haven't responded. What they have said is they think that they do comply with all of this. What's interesting about the DMA, though, is that this is the DMA. The European Commission did play a strong role in drafting these rules, and it's also responsible for enforcing them. And there are a lot of sort of subjective interpretations in terms of first complying with this. So I think what we are going to see is probably the European Commission taking a very strict view of what's reasonable in these circumstances, and probably really try to get strict adherence here. So it's going to be up to them to decide whether Apple is compliant or not, and then Apple can then sort of appeal to the courts. But I do think it's pretty likely we're going to see another fine in this and some behavioral remedies coming down the line.
You know, Alex, I love talking to Tamlin. Good guy, smart guy. But you know what? It just doesn't matter. Apple stock up 0.8% today. It's up 9% year to date. We've seen this time and time again where the Europeans just start nitpicking at these U.S. technology companies. Tamlin, what's the feeling within the regulatory environment of Europe as to really what they're trying to do here? Because it just doesn't seem like it's even relevant. I mean, it just, at the end of the day, they just, whether it's Google or Facebook or they just write checks here to make it all go away. I mean, is that kind of, do European regulators recognize that it just doesn't seem to be that immaterial what they're doing?
Right. Yeah, so I think if you look at this specific investigation, this is one that sort of came out of sort of Spotify, which of course is headquartered in Europe, and the app developers have complained that Apple is squeezing them too hard. So I think in some of these instances, Europe is trying to protect some local players by sort of ordering a sort of loosening of these rules that sort of maybe benefit the gatekeeper on the DMA, which would be Apple, Google, Microsoft, others, and they are sort of trying to show domestic industry that they are trying to pry open the markets. But I do think you're right that I think at this point investors are sort of kind of just shrugging this off. This is just one thing after another. I will point out that a difference under the DMA is that the timeline is really much quicker than under sort of former case law, where it may take 3-4 years until you got a result after an investigation. Here, this finding came just 3 months after the inquiry opened, and we're going to have sort of a final remedial measure by early next year. So I do think the timeline is faster. Whether or not this results in sort of the impact that the regulators might be looking for, I think definitely remains to be seen. And I think investors are definitely looking a little bit askew at it and thinking maybe this is sort of just more of the same.
And Alex, I mean, it's really almost maybe even more than 30 years ago that Microsoft started going through the same whole thing with the European Union. And again, investors became conditioned to, it's no big deal. They just write a check and it kind of goes away. The tobacco industry, investors kind of said, put it in context, it's not that big a deal. And you kind of wonder, given that the U.S. regulators have taken a very light touch to technology and then allowing these companies to get so big, it seems like the Europeans are trying to do what they can to kind of rein it in, but it seems almost too little too late.
Right, and also you can make the argument too that Europe doesn't have a lot of technology companies. They have some, of course, like ASML, for example.
Yeah, SAP.
But yeah, exactly, SAP. But I mean, can you name any more?
No, then that's,
I'm sure there's
issue.
Some, but I think that's kind of the point. If you take a look at European stocks versus the S&P in market cap like 20 years ago versus now, oh my gosh, forget that.
Really different.
Hey, Tamlin, what's going on with Apple in general? Like it seems to be making a little bit of a comeback here. It's actually up 0.6%, despite Nvidia, for example, down over 2%. What do you make of that?
Yeah, I mean, I think some of this comes from sort of the recent announcement to sort of build AI into the iPhone and maybe sort of accelerate the recycle in terms of getting people to buy those phones. I do think it definitely. I don't think the regulatory headwinds are really causing it much damage right now. I will point out that although the U.S. is definitely, like Paul said, taking a light touch approach, the one area they are getting involved in is on sort of these App Store rules, where Apple's obviously been in litigation with Epic for years and years and years. So I think on both sides of the Atlantic, there are some pressure on those services revenues that we might see shaking out over the next 9 to 18 months to see how that plays out.
So Tamlin, you've been based both in the U.S. And now in the U.K. What's your view of kind of the technology and landscape and the ability for new technologies to kind of be developed and to grow in the U.K. and Europe? What's your view, given your experience in the U.S.?
Yeah, well, I think the U.S. probably has more of a fostering environment for that startup stage. I think that's why you've seen some of your U.S. companies really flourish. I do think in Europe, they're trying to create that fostering environment specifically for the artificial intelligence field. I think you have seen there's an AI regulation that's taken effect, but I don't think it's nearly as strict as it could have been. And I think a large reason for that are lawmakers, specifically in France and Germany, really wanted to try to foster and incubate these AI industries that they had going on. So I think we'll have to see whether that works out and whether we have some European large-scale AI players. But I think historically, it definitely, I think you've seen more of that sort of startup fostering taking place in the U.S. than in Europe.
All right, Tamlin, we really appreciate it. Thank you so much. Do you like living in Europe, by the way? Are you enjoying the UK?
Yeah, quite nice.
Excellent.
Beautiful.
All right. I get you. It's not 92 degrees there with humidity. I'm just going to put that out there. All right, Tamlin, we appreciate you. Thank you, Tamlin Basin, joining us, Bloomberg Intelligence Technology Analyst from the UK. So here's my question for you, Paul. What do you think is going on with tech right now? Like, is this like a rebalancing to the end of the quarter? Is this like a pause? Is there something more disastrous going on here? What do you think?
I don't think so. I mean, again, I just got a note from Vince from out in the audience. Bid in stocks is quarter-end window dressing. That's all he's hearing so far. Vince Signorella kind of writing in here. So, no, I think tech is, I just think it's a pause here. I mean, I think they're going to be, the question for a lot of folks is, tech has been the leader in this stock market performance for years now. Can it continue to be? And I just think you look at the tech spending and you see where it continues to be a significant growth story. And just in terms of total tech spending throughout the entire tech stack, led by AI. So maybe the AI trade maybe got the sector a little ahead of itself, maybe time for a pause, but boy, that longer-term trend seems really solid.
Yeah, as Pinky Chada put it over Deutsche Bank, a breather. Just a breather. So looking in terms of that. Okay, well, we're going to get your update with Lorraine Gilbert. She's CEO of Wealthwise Financial. Her outlooks for the market and what is going on with technology. Is it a breather or something else? That conversation coming up next. This is Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The NASDAQ, well, under a bit of pressure right now. Shares are, it's in the red, down about 2 points at this point. A big part of that, NVIDIA, set for a third day of losses. NVIDIA shares, they're down more than 3%, taking its market value further below Apple and Microsoft. When we compare, we have the S&P 500 up 0.3% or 18 points. The Dow up 0.8% or 328 points. Now, what I want to do is take a closer look so you can really see this here, the breakdown of the 11 major industries industry groups, the biggest drag coming from information technology. Then you look a little bit further, you see semiconductors. A little bit further than that, you see at the top NVIDIA. Now, they are followed by Broadcom. Broadcom shares down 1%. Right behind Broadcom is Qualcomm. Their shares down more than 3%. And since we're talking tech, let's switch over to Apple, hit with that fresh EU warning over allegedly illegal practices on the App Store. Could lead to more fines. Apple shares up nearly 1%. Over to the bond market, the 2-year yield 4.74%, little change. The yield on the 10-year 4.25%, and that is little change. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa, Mateo. And as you're speaking, now the NASDAQ is flat on the day. I mean, go figure. I feel like we're definitely clawing our way back. Lorraine Gilbert, CEO of WealthWise Financial, is joining us right now for her take. So, Lorraine, Paul and I were talking just earlier about what is going on. Is it a tech breather? Is it rebalancing into the end of the quarter? Was last week kind of the start of something more severe? How do you view it?
Yeah, I mean, I think that, let's not forget, it's starting to be summer. People are off to the Hamptons, off to international trips, etc. So part of this would be just seasonality. But another part is I think we're going through a shift when it comes to AI from development to deployment. And so I think with that, we're going to see a broadening out of the market, not just the companies like NVIDIA that are the start of AI, but moving into how companies can monetize it. And so I think we're going to continue to see this broadening out with other companies that are able to actually profit from it.
What are some of those companies, or what are some of those sectors that can benefit from the actual deployment of this technology?
Well, it goes across all sectors, really. But when we think about even just industrials and how the technology here is going to be able to broaden out. Even companies like Caterpillar and John Deere are going to be able to use AI to improve efficiency. So really it's across all sectors, whether it's healthcare or industrials, et cetera.
So that's the AI play, and then you do like plus, let's look at valuation and where we're at. What's a good bet? Like, do you like industrials right now?
We do like industrials. We think that that is going to be a backbone. And when we look at infrastructure spending, that is going to continue to be a theme. And I think we have to take in mind where we are with the Fed and that we're definitely about to see rate cuts, and the question is just when do they start? But we know that trend is going to be our friend. And so I think you can't give up on technology. It's going to continue to be the driver here moving forward. And with interest rates that will go down, that's a risk-on move in the market. So we have to be mindful. But it is all about what are you buying and at what price?
All right, Lorraine, you're a graduate of the University of Texas. So that means by default, you must have an energy call. What do you think energy stocks are going to be doing here? How do you think about investing in energy stocks?
Yeah, we like energy a lot, and we like utilities. Looking at the play, just continued expansion and the need for energy with regards to AI. If you look at those numbers, they're astronomical. And so there has to be this continued build out and making energy more efficient. So we definitely like the energy play.
Where in the energy play? Because this is something that I've been thinking about. Like, oil companies aren't power companies, and power companies are the ones that are going to benefit. But utilities are regulated. So does that kind of change how you want to be investing in utility companies versus power companies? Where on that spectrum it makes the most sense?
Yeah, so it's true that utility companies are regulated, but what we're seeing is that there's just so much demand that the demand versus supply is going to be the story there. So definitely there, I agree with you, not so much just oil and gas companies, but really everything that is behind the idea of what's going to help with AI.
All right, so how do we think about, that's equities. How about fixed income here? What are you telling your clients these days about bond market?
Well, we love the bond market. We couldn't be, more excited about bonds, and who gets excited about bonds? So right now is a very good time, because when you look at where we are once again with rates going to be going down, the story is that all that money that's sitting in money markets is going to be moving. It's already started to move a little bit. And while some of it may land in the equity markets, a lot of it's going to end up in the bond markets. And so with that, now is the time to be moving money, because for people that are going to be in money markets, a year later, they're going to be very disappointed. And moving into the bond markets now, you have the yield, but you also have capital appreciation opportunities. We like preferred stock as well. That's another good play. That's fixed income to equity. So keeping it, though, I would say all high quality, not venturing into, as our economy has been softening, keeping it on the high quality side.
This brings up my question that I have, is that why are we convinced that money market funds are going to go somewhere else? Because if we're in a rate normalization cycle, it doesn't mean we're going to go back to 1% on the Fed funds rate. Like if we stay at 4, I don't know, 3.5, like why would I maybe take on more risk when it can sit there and still make money?
Well, because what you're doing is locking in to a higher rate for longer by moving into the fixed income markets versus seeing the rates continue to go down in money markets. So right now, if you move into just a 6-year duration on your fixed income, you're looking at between 4 to 5% on the yield with some capital appreciation opportunity that you can lock in for the next 6 years. That's what history tells us. So I'd liken it to, if you could go back in time a couple of years ago and lock into a home mortgage rate at 3%.
So if you could be Alex, basically.
Yes.
So if Paul Sweet could go back in time and be me, that's what he would do.
Be ecstatic about that. And so similarly, right now we have the opportunity in fixed income to lock in at the higher rate for a period of time, and instead of watching the rates go down.
Lorraine, you mentioned preferred stock. We don't talk about preferred stock a lot. How do you use preferred stock in your portfolio? Why is it attractive right now?
Yeah, so we use it as part of our fixed income allocation because you're getting a yield from it. But you also have equity-like exposure with some upside there. So it's this hybrid, as it were, and it gives off a very nice yield while you're waiting. So it is kind of this more conservative way, more conservative approach, and looks very attractive right now.
What do you think of corporate credit?
Well, I think that we would prefer agency, mortgage-backed securities, corporate credit. You in a diversified fixed income portfolio, you're going to have some corporate credit, but more so than that, agency, even treasury, but a smaller allocation, I would say, to corporate, just with the softening of the economy.
Lorraine, I was speaking with a large group of registered investment advisors recently, and I was surprised by how aggressive they were in terms of allocating their clients' portfolio to alternative investments, whether that's hedge funds, private equity, private credit. How do you view alternatives in a client's portfolio?
Well, I think alternatives have their space, and we allocate to alternatives as well, but it is a smaller piece of the puzzle. So, we look at, how much between equity and fixed income, and in all alternatives, in general, we consider that part of the equity exposure that gives us more diversification than just going long on equity. But I think you have to be careful because some alternatives can lock you in for a very long time. So liquidity needs have to be considered. And the other thing is, as they can be a diversifier, but that doesn't always mean that they're going to outperform other areas of the market. So yes, we use it, and we're always looking for what the opportunities are. I think there's been quite a bit of investment in private credit as an alternative investment, and I don't know how much more legs that really has.
Great stuff. Really appreciate it. Some counterintuitive views there. So fun to get. Lorraine Gilbert, CEO of WealthWise Financial. Kind of, sort of tempering expectations when it comes to private credit. Maybe it's not the bazillion-dollar industry that we all are thinking.
Yeah, and we'll see how the asset class performs here with these higher for longer interest rates, because you've got to, now some of the banks are kind of getting, maybe getting a little bit more aggressive in their leverage lending businesses here, trying to, kind of compete a little bit better with this private credit. But the private credit's done really well, particularly in the middle markets, where maybe some of the regional banks have dialed back since a great financial crisis, their risk-taking environment. So keep an eye on that.
Yep. All right, looking at the markets, the NASDAQ 100 now down by 0.2%. But honestly, nothing is happening. Volume is light. You got the S&P up by 0.3%, but it feels like a very muted day. I wonder if volume will be picking up as we sort of get to the end of the week with quarter end. All right, here's some world and national news for you. For that, we go to Michael Barr. Michael?
Thank you very much, Alex. Paul, Lisa, the U.S. Supreme Court agreed to decide whether states can outlaw gender-affirming care for minors, taking up what has become a politically polarizing issue across the country. The justices will review a federal appeals court decision that upheld Tennessee and Kentucky laws in the face of constitutional challenges by the Biden administration and transgender youths. The court will hear the case in the 9-month term that starts in October, focusing on the Tennessee law. Today marks 2 years since the Supreme Court's Dobbs decision that overturned Roe v. Wade and sent the issue of abortion to the states. Jen Klein, who heads the White House Gender Policy Council, says the decision has created a patchwork of state laws that has caused chaos and confusion and has denied women life-saving health care.
Women like Amanda Zarowski, a mom in Texas who nearly died after she was repeatedly denied care while experiencing a miscarriage. Women like Caitlin Joshua, who was turned away from multiple emergency rooms in Louisiana, also while having a miscarriage.
Jen Klein with White House Gender Policy Council. Israel's Prime Minister Benjamin Netanyahu said there will be no permanent ceasefire in Gaza until Hamas no longer holds any power there. Netanyahu, through an interpreter, made clear his position differs from that of President Biden. Netanyahu says Biden backs a 3-phase peace plan leading to a permanent ceasefire, but does not first require the end of a Hamas presence in Gaza.
If there is an agreement, it will be an agreement according to our terms. And our terms are not to end the war, to leave Gaza and leave Hamas as it is. I refuse to leave Hamas as it is. We need to eliminate it.
Netanyahu spoke during an interview on an Israeli TV station. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Right now, well, stocks are mixed. We have the Dow leading the gains this morning, up about 0.9%, 378 points, 39,527. The S&P 500 up 0.2%, 14 points at 5,479. We have the Nasdaq down 0.2%, 42 points at 17,645. The two-year yield 4.74%. That's little change. The yield on the 10-year 4.25%, and that is little change. To currencies, we have the Japanese yen 159.58 against the dollar. We'll head over to Bitcoin now. Oh, extending the losses. Bitcoin down more than 3.5% at around 61,000 right now. And I want to check in with other cryptocurrency linked companies. Because of that, you have Coinbase Global. They're down about 3.5%. Then you have Marathon Digital Holdings. They're down nearly 2%. Quick look at commodities. We have spot gold higher, $2,331 an ounce to $31 an ounce. Brent crude, $85 a barrel. WTI crude, $81 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our analysts from Bloomberg Intelligence. They cover 2,000 companies in 130 industries worldwide. And Friday means the end of the second quarter. We will be halfway through the year. So it's that time where we're getting all the mid-year outlooks, which are super helpful, particularly from Bloomberg Intelligence. And joining us in studio is Michael Halen. He's Consumer Products Senior Bloomberg Intelligence Industry Analyst. Michael, in studio, we're very excited about this.
I'm excited too.
Thanks for joining.
He finally
came in.
Pass was.
Yeah.
It took
New Jersey Transit.
I was digging through my junk drawer, but I found it.
He found it. It was just important. Well, I mean, is New Jersey Transit even running? I think is more the question.
So. It's tough.
Nice. Okay, so mid-year outlook. Give us the broad sweeps. Like, what are you expecting for the back half? And then we can get to specific stocks.
Yeah, sure. Broad sweeps, I'd say sales are probably looking a little bit better just because than they were in the first half, because the year-over-year comparisons are getting easier. Higher income consumers should have money to spend, right? We see stock markets at all-time highs. Bitcoin's having a rough day, but not far off the highs, and home prices have held in despite the higher rate. So those should kind of buoy restaurant sales. But on the other end of the K, the low-income consumers continue to struggle. Consumers under 75,000 were cited by Darden the other day on their earnings call as struggling, especially consumers that are earning less than 50,000. So we have kind of a push and a pull there. Margins are okay. We would like to see better sales because that's really what drives most of the margin expansion in that business, right? There's a lot of operating leverage in the model. So maybe some modest margin expansion. And the stocks generally haven't done so well this year. What we wrote is that we think we're going to see a larger spread between the stock market, the market share winners and losers this year, which we've largely seen in the first half. You'd seen stocks like Chipotle, actually absolutely knock the cover off the ball again, and really appreciate where other chains like Darden, Darden's done pretty well. Like Bloomin', I should say, is kind of struggled in the first half, and you've seen that stock, sell off pretty precipitously.
Talk to us about California and their new minimum wage law. What's the impact been on the fast food business?
Did we just have like a famous Hollywood restaurant close because of that? Like a famous Hollywood McDonald's or something?
Oh, San Fran.
Yes.
They announced today San Fran closed. Yeah. So it's not been good so far. April results were kind of in line with the U.S. in terms of same-store sales at quick service restaurants. But I think everybody went in April, and then they got sticker shock, and they did not return in May.
Because the McDonald's of the world, the restaurants in general in California, are they raising prices to cover their higher labor costs?
Yeah, high single digits is typical,
wow, that's a lot.
Which is a lot. And that's not even covering it, because the traffic loss that we've seen here in May, it's not even going to cover it. So they may even have to raise prices again if they can. Quick service California same-store sales underperformed by almost 400 basis points in May versus the U.S. Yeah, so, what we wrote is that we expect quick service to continue to outperform casual dining just because it's a cheaper check, even though it's gotten all the bad press about the $18 Big Mac meal, $22 smash burger meal. It's still, you can eat there a lot cheaper on the value menu and stuff like that. Also, chains are starting to discount more. Burger King and McDonald's, $5 meals, things of that nature. But California is definitely going to weigh on quick service growth throughout year end, for sure.
So as the K-shaped recovery grows even wider, it feels like so do the valuations of those companies that service those two lines. Is that a fair statement?
Yeah, if you're a chain that can attract high-income consumers, like Chipotle's done such a good job of doing, and McDonald's has done a good job of it as well since the start of the pandemic.
Chipotle is your Wednesday day, Paul?
It varies, but it's one day a week they get Chipotle. But here's a funny Chipotle story. They got slammed in social media for underfilling their tacos and things like that. Now they've gone overboard and they overfilled them. So the net result for me, instead of getting 3 hard tacos with chicken, and I'll give you the whole order later, I only get 2.
Oh, there you go.
So it's got to be hurting their sales. So that is an interesting tidbit.
Yeah, so we were thinking about doing some work into it, but we haven't done anything yet. All
right,
there was definitely some heat and some shade thrown at Chipotle for a little while there.
I'm going to say a year and a half ago, somebody came in here. This is kind of the beginning of this whole AI thing. And somebody came in to this studio and said, one of the biggest areas is going to be, like, for example, drive-through. Going through a drive-through at McDonald's, it's going to be all AI, blah, 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 blah. So my question to you is, are local, I don't know, McDonald's or Burger Kings, do they have fewer employees because they're using technology or at all like that?
Well, they have tried to cut labor hours in other ways. That's a goal using AI for sure. It's been harder though at the drive-through than anticipated. A lot of things, just like accents, something like that. Actually has caused some issues. Something else, they're also using AI with these cameras that are using AI to see if orders are being packaged correctly. Since takeout and delivery has become such a big part of these businesses. But, one of the companies that was doing that got caught using people in India watching screens, videos, supposedly quote unquote AI. So we're not quite there yet with the AI in that.
That's so interesting.
Of the business,
because the practical application, how it really makes a difference, we may not quite be there yet. Here's my question. If you and Ken Shea from Bloomberg Intelligence, who covers many things, but in particular, he covers all the cannabis companies, got together, what is your interplay between you guys? And I'm not actually trying to be that funny, but with all the weed stores coming up and you can get kind of cannabis anywhere in many places, does that have a direct impact on the companies that you cover? Have you noticed something along those lines?
They haven't necessarily attributed any, lower alcohol sales to that,
or more food sales or munchie sales.
Yeah, we've had some of our companies like Jack in the Box and other companies that do a big late night business kind of lean into that stuff on their advertising. They've used Snoop, in some of their stuff. I think Ice Cube now is
But on the flip side of that is the GLP-1 situation.
Truth.
Is GLP-1, is that real? Because your companies have called it out.
Yeah, but the panic over it seems to have subsided.
Okay.
Is it real? Yeah, but there's still a lot of question marks. There is definitely concern because people are less likely to go to fast food restaurants. There's a lot of people saying they feel sick eating fast food on GLP-1s. There's a lot lower alcohol consumption on GLP-1. So it's definitely something that's being monitored. But right now it's still such a small it's just had such small distribution so far. I think what's going to be more of a concern is once it's in a pill or something that's easier than a shot.
Yep, right. It's interesting. So I'm looking at the S&P Restaurant Index member returns. One of the second worst performing stock for restaurants is Cracker Barrel, Old Country. That kills me. because I'm a huge advocate for Cracker Barrel, so
Yet
I
to
don't know
be
why the stock's not working. All right. I'll go out and get my country boy breakfast. All right, Michael Halen, Bloomberg Intelligence, thank you very much. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Federal prosecutors recommending criminal charges against Boeing for violating a settlement over 2 deadly 737 MAX crashes. Now, that's according to a report from Reuters. Bloomberg Intelligence's George Ferguson says this comes as a bit of a surprise.
Coming out of the MAX grounding and those crashes, the crashes obviously beforehand, I would have expected they would have worked pretty hard to put all of those controls in place that they were asked to do. So I think very surprising and just another indicator of the challenges at the company right now.
And Boeing shares right now up 2%. Shares of NVIDIA extending their losses down more than 5%, and it's on track to wipe out nearly $300 billion in market cap. Bloomberg's Ed Ludlow explains a concern.
You have this big backlog of business, and supply constraint is a big boost to you. But if you keep bringing in new technology, won't you have a really big pool of frustrated customers who say, hold on, I've just waited 2 years for the H100, and now you're telling me that your latest AI accelerator renders the thing that I spent so much money on obsolete.
Now, while NVIDIA is falling, other big names like Apple, well, they're advancing. We have Apple shares up nearly 1.5%. Speaking of which, the company's been hit with a fresh EU warning over allegedly illegal practices on the App Store that may lead to more fines. And meanwhile, the Wall Street Journal reports reporting that Apple has held talks with Meta about integrating Meta's generative AI model into Apple Intelligence. You have Meta shares up 0.7%. And sticking with tech, we'll say sources saying Broadcom in talks with ByteDance to develop an advanced AI processor. For Broadcom shares, they're down about 2.5%. Moving the markets, that's RXO. Their shares up more than 20% after word that it'll buy UPS's Coyote Logistics for more than $1 billion. UPS, their shares are up about 2%. That is your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and business and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide, and we keep you up to date on all world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, Lisa. Is it a hopeful sign toward peace in Gaza? It comes after an interview with the Israel Prime Minister. Bloomberg's Ed Baxter has the story.
PM Benjamin Netanyahu is now saying that intense operations in Gaza will end very soon. He says the next step will be to get some troops into the north to counter Hezbollah aggressions and to bring some local residents back from where they were evacuated. He says he wants to do it by diplomatic means, but if not, he'll go another way. Meanwhile, he's sending Foreign Minister Yoav Gallant to the U.S. to talk about additional aid, which he says has been slowed down. The U.S. has consistently denied the allegation. Ed Baxter, Bloomberg Radio.
A completely random, senseless act. That's from the director of the Arkansas Department of Public Safety about the mass shooting at a grocery store in Fordyce. The alleged gunman will be in court later today. 4 people were killed, 9 others wounded, including 2 law enforcement officers. Colonel Mike Hager praising the 6 officers on the scene and condemning the alleged gunman.
The actions of the suspect were the most cowardly, pathetic actions imaginable, as he was literally preying on defenseless victims, the majority of which were female.
Hager says the suspect, 44-year-old Travis Eugene Posey, had a shotgun and a pistol. The Supreme Court is stepping into the fight over transgender rights, agreeing to hear appeals from the Biden administration and families seeking to block state bans on gender-affirming care. The justice's action today comes as Republican-led states have restricted health care for transgender people, school sports participation, bathroom usage, and drag shows. The Dali cargo ship is headed out of Baltimore for Virginia. It departed this morning nearly 3 months after it lost power and crashed into one of the Francis Scott Key Bridge's supporting columns and caused the bridge to collapse. The Dali is heading to Norfolk for the removal of the remaining containers on the vessel and additional repairs. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, and now Charlie.
All right, thank you so much, Michael Barr. So apropos of our cannabis / fast food convo we just had, here's something from the Wall Street Journal. The question is, do Americans drink too much? We know the debate has been around for a while, but we could actually get some real changes here. So the current guidelines say it's safe for men to have 2 or fewer drinks a day and for women to have 1. And that could change in 2025 when the Agricultural and Health and Human Services Departments update recommendations that are part of the federal dietary guidelines. And for the first time, the guidance on alcohol consumption is being considered separately from overall dietary guidelines. And now we might get some changes on that kind of, this is what you can drink and still be healthy information.
I didn't know there were like rules out there. Or
yeah, you didn't
suggestions.
Yeah, it's like 2 drinks a day for men, like rock on with your bad self.
Okay.
But other than that, then we're not so good.
All right,
but if that changes,
oh my goodness,
if you go to 0 or 1, Paul.
Well, how about the gummy thing going on out there? I think some people are substituting little gummage for drinking.
I would totally agree with you. I mean, like anecdotally, so I don't partake in the gummy situation.
Right. Me neither.
But at parties, like with friends, and it's, I'm clearly not a college kid, it's the gummy can goes around.
Does it?
To all the adults, absolutely.
Oh, I haven't seen that.
So it's sort of like what you would do when you were maybe in college and maybe with some apparatus that you smoke weed, right. One might say. Now it's just the gummies kind of go around the circle. But I don't know. Yeah, I don't know if we have like federal dietary guidelines, if that would be coming for cannabis also.
Yeah, I don't know. I mean, the gummy store, I went to my first dispensary, state dispensary in New Jersey. It was kind of interesting. It was kind of like going to an ABC store like in Pennsylvania. Kind of, it's not. It was fine. It got the job done.
Yeah, we have a house up in Massachusetts when they've been legal for a while, and it's like a thing. Like, to show your ID, it's like a hardcore. It's not one of these random shops that sort of come up everywhere.
Which they've closed down in Manhattan. A lot of them.
A lot of them, but there's still tons of them. All right, coming up, we're going to cover these markets for you over the next hour as well, and talk about Bloomberg BNAV. This is Bloomberg Intelligence Radio.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we're going to start off this hour strong. Abigail Doolittle will join us in studio. We're going to get the latest on what's happening in the markets. We got the Dow up 1%. What's going on there? We'll check it out with Abigail. Steve Mann, Bloomberg Intelligence Global Autos Analyst. He's going to talk to us about what China's trying to do to deal with some of these tariffs that have been placed on their vehicles from the likes of the U.S. and Europe. So we'll get his perspective there. Bo Quinn, Bloomberg BNEF lead U.S. carbon analyst. We'll talk about the global carbon market and the price trends in the U.S. So we got a lot coming up in this hour, and let's kick it all off with our good friend Charlie Pellet. Charlie, what do you have?
Thank you very much, Paul Sweeney. Happy Monday to both Paul, Alex, and right now we have got the Dow, the S&P both higher. You mentioned the Dow up by 1%, up 394 points. We've got the S&P up 0.3%. Truly, though, a very mixed market today with NASDAQ slumping 0.3%. A renewed bout of volatility is gripping stocks as a plunge in NVIDIA raises concern that the rally in big tech could be due for a breather. NVIDIA down another 5.4%. We've got the 10-year yielding 4.26%, the 2-year 4.74%. Spot gold up 0.4%. Right now at 23.31. West Texas Intermediate crude 81.12 a barrel, up 0.5%. As for the economic backdrop and the equity market outlook, Lori Calvasine is head of U.S. equity strategy at RBC Capital Markets, and she was the guest this morning right here on Bloomberg Intelligence.
If you go back and look at the GDP forecast for 24, last summer it was tracking at 0.6%. 0 to 2% is a lousy environment for the equity market. You typically see stocks go down when you're in economic purgatory like that. But 2 to 4%, and now 2024 is tracking around 2.4. That's typically a very solid environment for the stock market. The average gains, I think, are like 12, 13%, somewhere in there.
Lori Calvasine of RBC Capital Markets, interviewed right here on Bloomberg Intelligence. Another tough day for auto dealers across the country. At least 4 publicly traded auto dealers have warned the SEC in recent days of possible financial impact from that cyber attack last week that stalled service at car dealerships across the United States and Canada. Among some of those names, it is not affecting the stocks for the most part, but among some of those names, Sonic Automotive up today by 2.3%. Group 1 Automotive up 2.6%, AutoNation down 0.1%, and Lithium Motors up 1.7%. Again, recapping, decidedly mixed market. Our Abigail Doolittle will have a whole lot more coming up in just a moment. S&P up 0.3%, NASDAQ down 0.2%, and NVIDIA one more time down by 5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. I'm Alex Steele alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio, and happy Monday, everybody. I hope it's not 1,000 degrees outside anymore. So talking about the markets, you were mentioning NVIDIA, Charlie Pellet, and that is definitely sinking and having a tough day. Abigail Doolittle is joining us for more. Abigail, why? Why is the stock down? Let's just start with something basic.
I think that it's probably because of the epic rally up into this recent sell-off. Into Thursday morning, the stock on the year up 180%. I mean, the numbers are pretty impressive in terms of the growth. We're looking at triple-digit growth on both the top and bottom line, and these are not small numbers either, and that's expected to continue for a number of quarters. But I think just too far, too fast. It is a parabolic uptrend per physics. A 90-degree angle cannot hold. There's only one exception to that based on all of my market watching over the number of years, which is Tesla back in 2014. Yeah. But gold, silver, all all of these other charts, they tend to fold in on themselves. I'm taking a look at the NVIDIA chart right now, just technicals, because the technicals gather the psychology and all the information that people know. And I would say we're looking at the possibility of a continued reversal, maybe down toward the, it's hard to say right here just because of the split, but there's some gaps. So there's a significant gap down at, let's see where it is exactly, about 95 or so. If that gap does not fill, we could actually be looking at the possibility of a super bearish chart, but there would need some impetus for that. There's no information coming out of NVIDIA as far as I know from that standpoint. So it would be the rest of earnings, maybe supply chains, or maybe the Fed. But the other piece of the chart right now, the RSI, the momentum indicator, steadily out of the overbought territory, but it's also not oversold, suggesting that this selling is going to continue. Some folks taking some chips off the table.
Yeah, it's just interesting to note that it's now fallen below the $3 trillion market cap for those that keep count. 2.96 trillion here, so that's just kind of a nice round number. What I always find interesting about NVIDIA is that you could argue this company's earned its way into this crazy stock price performance. I mean, on a trailing ETF basis, 70 times PE. On a forward, 45. You go out just one more year after that, you're down to like 30 times earnings. And for a stock that's growing its top line so quickly, a lot of bulls will tell you this is not a crazy valuation.
I don't disagree with you. It's interesting. When I pulled up that valuation last week or the week before, I was sort of stunned by how reasonable it was. And again, those growth numbers are just incredible for the top line. I think that the big thing here is everybody knows or suspects that at some point they're not going to put up the same kind of quarter, the same kind of guidance. When that happens, the music's going to stop. Now, are people getting early signals that that could be ahead, and so they're taking, some money off the table? I just don't know. That technical analysis is useful for that. If we continue to have a sell-off and there's nothing particular to NVIDIA and the macro sort of stays status quo, it would suggest that there are people who have their ear to the ground more closely within the supply chain, that NVIDIA is not going to quite pull in the growth on AI that is expected.
Well, it also raises the question, too, just the practical applications and sort of the derivative plays of NVIDIA, which brings me to IBM. Like the boring old school, sorry, IBM, but the boring old school tech stocks having that AI derivative and that stock getting an upgrade, or started coverage, I should say, from Goldman Sachs with a buy rating and a price target of $200, doing really well today.
Yes, it's doing very well today, up 2.6%. And it's interesting you're mentioning this because Matt Miller and I earlier this morning, we were talking about, right now it's all about the rotations. Are we going to finally see the rotation into value? But I would argue maybe we're also going to see a rotation out of high growth tech and into sort of old school tech. IBM getting this nod right now. I'm going to just pull up the chart very, very quickly and see what it suggests. Oh, it's kind of interesting. So, yeah, it's actually not surprising. It's actually the inverse of NVIDIA in a way. And it looks like in the way that NVIDIA could go into a pretty bearish pattern, there's the possibility that we're going to see a nice pop from IBM. Paul, you were talking about the Dow. The Dow up 1%, the S&P 500 up just modestly, the NASDAQ 100 down 0.4%, and the SOX down 1.6%. The Dow today benefiting from the fact that NVIDIA is not in it. That's usually not the case all year. Okay. It's really fallen behind because NVIDIA is not in there. But yeah, most members of the Dow are higher, and that big NVIDIA drag is just not happening there.
All right, Tom Keene's not here, so I can ask this one real quick.
Do it.
Bitcoin down 4% today, 61,000 and change. I don't know. Just more sellers and buyers here. Are you hearing anything?
It's an interesting technical picture right now. If Bitcoin can hold, let's just call it $60,000 per Bitcoin, we likely pop back up into the range toward 70,000 or higher. And then we're going to see, will the range break out to the upside or to the downside? If we go below 60,000, we're then watching, let's call it 56,500. If below that level, we're going to see a pretty significant slide down toward, I would say, somewhere between 30 and 40. Wow. The long-term chart suggests that's more likely just for consolidation to the uptrend, and that's been very healthy over the last, 5, 6, 7, 8, 10 years, however long you want to call it. This particular uptrend is about 6 or 7 years old. It's not clear, though, if that break to the downside, that consolidation is going to happen right out of this piece of the range, or if we're going to go back up and then down. But I would say at some point we're going to be testing those lower levels. If you look at Bitcoin and crypto as a risk-on, risk-off signal, typically, it is. If that breakdown happens, it would suggest that the macro is somehow turning risk off. Although Matt made the good point. Matt Miller made the good point.
Matt Miller made a good point?
Lots of great points. Lots of great points. He made the good point that if if we think the Fed is kind of done cutting and you look at Bitcoin as digital gold, like who needs it?
Right. Yeah.
All right.
That was a good point.
Okay. See, he does it. He does it. High five for that. All right, Abigail. Thanks a lot. Abigail Doolittle joining us, Bloomberg News markets reporter. So here's a headline for you. Black suit cybercrime gang is blamed for major CDK ransomware attack. So this is the deal. 15,000 car dealerships across the U.S. and Canada have gone days now without software systems that are crucial to running their business. And this is after multiple cyber attacks on CDK Global. Now, that company is just a handful of dealer management systems that provide auto retailers ability to basically function, schedule appointments, customer records, etc. And so apparently Black Suit Cybercrime Gang is blamed in that attack.
It's a real deal. A buddy of mine manages a dealership in Jersey, and he said it impacts everything they do. And the net result is it just takes longer to serve your customer, gives them more time to walk out the door. And so it's impacting, a little bit of an impact on units sold per day they're noticing. So they need to get that fixed as quickly as possible.
And that's interesting. But also, like when you go to a car dealership, you already spend half your day there. So you extend it and forget it. Steve Mann is Bloomberg Intelligence Global Autos and Industrials Research Analyst, and he joins us now. Steve, you've been following this and the hack. What happened?
Oh, this is very significant. Paul just said he spoke to some of the dealership in New Jersey. I've reached out to some of the dealerships that I've talked to. The impact is significant. It's not just only sales, but it's also service and parts. The system's interrupted to a point where they can't even get certain cars registered and delivered to their customers, the ones that's already sold. So, inventory is going to get a little pickup. It's going to be, I don't know when it's going to get fixed. They probably have to pay that fine, and I think they will pay that fine. But at the end of the day, I think if I look at it from the automaker's perspective, it's a temporary blip. Inventory is going to rise, but I think sales will be delayed. And hopefully when this gets resolved, customers will come back. More customers will come back to the showroom.
And it seems, Bloomberg News reporting CDK plans to make the ransomware payment.
Oh,
God,
really?
That's frustrating. It's just, But I guess they kind of have to. I don't know. All right, Steve, talk to us about China, Europe, tariffs. We've got the European Union reporting, we talked to you last week, initiating some tariffs here. Now Beijing's kind of responding here. What's the latest?
Yeah, it's a big deal for the German, especially the luxury automakers like BMW, Mercedes, and Audi, which Volkswagen owns Audi. They have about 80% of the market, the luxury car market in China. So they sell a huge amount of cars in China. About a third to 40% of these companies' revenues actually generate in China. So they want to make good with the Chinese. As you know, Germany has been against the tariffs. So if the Germans are able to get something from China and help ease some of the tariffs, or China, if China can get the Germans to help them ease some of the tariffs in the EU, I think it'll benefit, potentially companies like Stellantis as well, which also has a new joint venture.
But here's the thing that I get confused, is that China's making a pitch to individual countries versus the European Union trying to operate as one body in relation to tariffs. And I wonder how that's going to work itself out.
Yeah, I think it's that divide and conquer strategy they're taking. So, but I think the Germans probably has the most to lose out of the global automakers here. About 16% of their battery electric vehicles that are produced in China is actually shipped out globally. So China plays an important part for the BEV market as a low-cost producer. So, I don't think there's a lot of other automakers that are, that have that many BEVs produced in China and sold elsewhere around the world.
And Steve, just a red headline crossing the Bloomberg terminal now. Canada now gets into the game. Canada announces plan to curb imports of Chinese-made EVs. What's going on here? First of all, just give us a sense of how good, how competitive are these Chinese EVs? Because if you tell me they're good vehicles, let's bring them into the market. I don't know.
Yeah, I think if you talk to some of the automakers, they actually have the same thinking. Let's compete, right? I think competition will make the whole industry better. You saw that with Tesla being the fourth or third automaker in the U.S. and actually helped drive a lot of the BEV costs down. But it's not surprising that Canada is implementing tariffs. They are part of the U.S. Mexico-Canada Free Trade Agreement, and I think they have to close that door, that back door where the Chinese EVs can come in. It is very competitive. I think Chinese EVs are cheap enough that if some argue that even with the tariffs, even with some engineering change so that they fit the regulatory safety and emission rules here, it'll still be a very competitive price vehicle for North America.
So then to that point, we're waiting for Mexico now, right? Because I think we talked about this before. So not only is Canada going to put tariffs on EV imports, they're also going to curb imports of Chinese-made EVs. The idea is that if Mexico doesn't have any of those restrictions, that they can just import EVs from China and then through Mexico go into the U.S., and that's a different way of operating. When do we get that from Mexico?
I think there are some negotiation that's happening now with Mexico to kind of implement similar tariff. I've heard that Volvo is already kind of lobbying. Volvo is actually part of Geely, is actually lobbying the Mexican government to not implement, to not put tariffs in place. So the negotiations are ongoing. I don't think we're going to have to wait too long to hear any news from that.
All right, so stepping back a little bit, give us the latest thinking out of Detroit and other auto capitals around the world about EVs versus the hybrids. Is the hybrid going to be, I guess, the stepping stone to a pure EV environment, do you think? Is that still the thinking?
Yeah, I think that is still the thinking. I think with BEV sales slowing down or growth slowing down, the automakers do need something else to meet the CAFE, the fuel economy regulation, the emissions regulation. So hybrid is a stopgap measure. But if you talk to all the automakers, they're still spending a lot of money on BEV. They think that is the future because at the end of the day, hybrid vehicles do still spew out pollution or greenhouse gases. So, these emission standards, these fuel economy standards, they're only going to get tighter and tighter.
All right, Steve, we appreciate it. Thank you very much. I feel like your sector is moving so fast right now in terms of all the rules and regulations. Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. I wonder if it's going to be more of a mix of just battery hybrids and EVs and ICEs, and it's sort of like a happy trio that we wind up moving forward with at the end of the day.
Yeah, I think it's just, I think what's just kind of evolved over the past year, it seems like, is just, let's just tap the brakes a little bit on the timeline of this move towards EVs. I think, as Steve's mentioned, we're still going to, that trend is still there, but maybe just at a slower pace, maybe.
Yeah. All right, we are going to have much more coming up for you. Coming up, Bo Kin is Bloomberg NEF lead U.S. carbon analyst. It's a really important market, and we are going to learn about it. Paul's really excited. This is Bloomberg Intelligence.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, they're both higher. NASDAQ in the red right now, looking at a 19-point gain in the S&P 500 index, up by about 0.3%. The Dow up 370, up almost 1% right now, but NASDAQ down 22, a decline of 0.1%. NVIDIA certainly weighing on the market today. We've got NVIDIA lower now by 5%. A renewed bout of volatility is gripping stocks as a plunge in NVIDIA raises concern that the rally in big techs and the overall market is due for a breather. 10-year, 4.26%. The 2-year, 4.74%. Gold up 0.4%, 23.30 the ounce. And West Texas Intermediate crude up 1%, 81.57 a barrel. Prosecutors have recommended to senior Justice Department officials that Boeing face criminal charges for violating a settlement relating to 2 fatal crashes. That, according to Reuters, citing 2 people familiar with the matter that it did not identify. Boeing shares today, they're gaining. Boeing right now up 1.9%. Recapping, the S&P up 17, up 0.3, NASDAQ down 0.2, NVIDIA lower by 5.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance with our lens of our Bloomberg Intelligence Analyst Group. They cover 2,000 companies and 130 industries around the world. And every week at this time, we also bring you some data from Bloomberg NEF, Bloomberg New Energy Finance. Its research covers commodities, power, transport, industry, buildings, ag sectors, as well as cutting-edge technology and sustainability as we work our way through this energy transition. And today we're going to talk about the carbon market. Joining us is Bo Kin, Bloomberg BNEF, lead U.S. carbon analyst on a global carbon market. So first off, we're going to dumb it right down. What is a global carbon market?
Thanks, Alex. Great to be here today. Yeah, carbon market is a large market that is growing very quickly. What I look at particularly is compliance carbon market, where we set a cap on emissions and allow entities to trade under the cap. There are also another set of carbon market, which is more focused on voluntary obligations and voluntary commitments. But the growing part here is really the compliance carbon markets, where we have seen a huge increase in not only traded value, but also emissions covered. Today, we have almost 20% of global greenhouse gas emissions covered, mainly boosted by countries and regulators' net zero commitments. We have now almost 150 countries with a net zero carbon target, and with 145 states and regions with a net zero carbon target as well. And with those, they have been looking for different ways to reduce emissions, and carbon markets, particularly compliance carbon markets, have become one of those tools to drive that emission reduction.
So there isn't a federal carbon market for the entire U.S. It's state by state?
Yes. So right now, we don't have
Who decided that?
Which is so weird because we all breathe air, and it's all the same air. That's also weird.
All right, but can somebody just explain what a carbon market is?
Yeah, so the carbon market basically is a regulator set a target, and there are 2 types of carbon markets. So there's a cap and trade, where the regulator set a cap and the entities under the cap trade with each other. So
just pause for the second. So basically that means that a company is only allowed to have X amount of emissions, say, a year.
Yeah.
And then if they go over that, they have to trade those emissions and spend money buying them to then say, look, I've offset that.
Yeah, it really actually depends on what kind of carbon market. So there are 2. Cap and trade is basically you set a cap on overall market. So it's comprising of all the sectors that you want to set a cap on. Then it doesn't really matter which company reduces. The advantage here is really that the one who has the cheapest abatement options, they reduce first. And those that are more hard to abate, they can basically chill and pay for the permits to pollute. Meanwhile, the cheaper sectors would abate for them. There are also other types of carbon markets. The other type would be a baseline and credit, where it's what you mentioned. You set a baseline, and then if you're above the baseline, you have to buy credit. If you're below, then
you can sell into the market and make money
exactly,
on it.
Exactly.
I'm busy Google Maps Finland. Because, Bo, you grew up in Finland?
Yes.
I mean, I had to Google Map it because I kind of knew generally part of the world where it was. But go on, Alex, you continue because this is fascinating.
But actually, it's interesting that you wind up in this industry coming from Finland, because I feel like the Scandinavian countries have done really well when it comes to managing their carbon emissions. Why do you think that they've done so well versus the rest of the world?
I think at the end, first it is that in Finland or in Scandinavia, we have the motivation. So that first you start with the target. And
that's the government part, right? Like they put on,
exactly,
so they have strict government targets and they've had them for a while.
Exactly. Mm-hmm. And then you find different tools that will guide you, help you to get to that target. So it pretty much is like a fitness plan when you first set your fitness target, and then you find the different tools to guide you there. And in Finland, in carbon markets, really, we can't really deliver alone those net zero target or whichever target you have set. We do work in collaboration with other policies. For example, you usually have subsidies for different technologies, for carbon capture, hydrogen, or renewable energy, in addition to having a carbon market. The advantage really with the carbon market is that you have a price transparency. You typically, when we talk to people, they don't, investors or policymakers, or just normal people in the society, they don't know what decarbonization means and what it costs. And carbon market helps there. It helps bring that transparency and bring a number of value to what decarbonization means today and in the future. Particularly it's in the future, that's the area where a carbon market can help with, because for example, those carbon prices that you see today, we have seen, just in America, we have seen those compliance carbon markets. So California's price has doubled since 2021. Now we have drifted slightly downwards, but we hit a record of $44 per ton this year, which is quite significant. And we have seen here in Northeast US, there's the power market, carbon market, and the value has tripled since 2021, really highlighting that the price for decarbonization has increased, and it is important for these states.
How about some of the huge developing economies like China, like India? Are they worried about their carbon emissions? Are they doing anything?
Yeah, they're helping as well. And they have, like China has done quite a lot in helping the energy transition globally. Well, first, they also have a compliance carbon market. They started a few years ago, and in terms of covered emissions, it's actually the world's largest. Everything with China is the largest. So it's 4 gigatons of emissions covered. It's only power sector at the moment, but they are looking into expanding it to cover industries as well, like cement. One of the things that has also driving this carbon market expansion is not just the net zero targets that we have been talking about, but also there have been more carbon border adjustment mechanism being introduced. So EU started first with their carbon border tariff, and now UK also is looking into setting one and announced that last December. And there are also Canada and Australia looking into this, and US we're also looking into it, but it's maybe harder because we don't have, as I mentioned before, we don't have a federal carbon pricing yet.
Because here's the problem that I have for all companies: if there isn't a unified carbon price, it's very hard then to go back to investors and the board and say, we need to take these actions, because if not, it's going to cost us X amount of money because of this carbon price. Like, there isn't that. And it feels like the energy transition for a CEO is going to be a really hard sell for a lot of CapEx investment without that carbon price. Will we ever have some kind of global carbon price, even if there's small differentials like we see with steel prices or even oil prices? Will we have one?
Probably not in the near future, but hopefully we'll have more regions with similar carbon prices. So we'll have, in a way, like carbon clubs, where those who share the similar carbon emission reduction target and have the similar tools to direct their economy towards those target would share. So EU already has a compliance carbon market, which is currently the largest in the world. So that sets the baseline for setting carbon pricing in Europe. Of course, Finland has much larger, much higher targets and a larger carbon price as well. And here in US, we have also seen higher carbon pricing in those coastal regions that have also higher emission targets.
All right, good stuff. I'm going to leave it to you two experts to figure this whole out. Boken, she is a lead U.S. carbon analyst for, I didn't even know there was such a thing, for Bloomberg BNEF. That's a great thing. Keeping an eye on what's happening in the global carbon markets. Just looking at the markets, I understand, like the stock market, the S&P 500 is up about 0.3%. The Dow up 1%. The Nasdaq's off about 0.3%. Bitcoin continues to be of interest, down 4% right now, 61,100. I guess just more sellers than buyers as it relates to Bitcoin. And calling out WTI crude oil, it's up about 1% today, $81.50. So we'll keep that in mind. With our news in New York City, Michael Barr.
Thank you very much, Paul. Alex, Charlie. President Biden spent the weekend preparing for the first televised debate with former President Trump, who was out addressing rallies. Bloomberg's Irv Chapman reports from Washington.
Most of the audience is well familiar with the two candidates' style and personality, Terry Haynes, founder of Pangea Group, said in a Bloomberg interview.
Biden has to show that he's up to the job and show that he's a kinder, gentler, centrist, safer pair of hands compared to Trump. Trump, of course, has to embody dissatisfaction with the economy, dissatisfaction with the border, and convincingly promise that he's able to make it better.
Trump would greatly improve his prospects if he unified his party by tapping Nikki Haley for vice president, Haynes said, but he's unlikely to do that. In Washington, Irv Chapman, Bloomberg Radio.
The lone suspect in a mass shooting at a grocery store in south central Arkansas is due in court today to face charges in the deaths of 4 people and the wounding of 9 others. 44-year-old Travis Posey was taken into custody after exchanging gunfire with police. Arkansas State Police Chief Mike Hager says the youngest to die was 23-year-old nurse Callie Weems.
She was shot while rendering aid to another gunshot victim. Instead of fleeing the store, she stopped to render aid.
Chief Hager says Weems leaves behind a 10-month-old daughter. Russian authorities say more than 15 police officers and several civilians, including an Orthodox priest, have been killed by armed militants in the southern Republic of Dagestan. The gunmen opened fire on 2 Orthodox churches, a synagogue, and a police post. Prime Minister Benjamin Netanyahu says he will only accept a partial ceasefire that does not end the war in Gaza. Netanyahu told Israel's Channel 14 the military will continue its campaign to eradicate Hamas from Gaza, but switch to more targeted operations. Global news 24 hours a day and whenever you want it with the Bloomberg News Now.